Hello, welcome everyone to today's training session. Good evening, I believe, for most of you joining us in Fiji. Thanks for joining us at the end of your day. We really appreciate it. I'll give you all a moment just to find your settings as we're getting started. We've got lots of attendees joining us now. Whilst we're waiting, feel free to introduce yourselves in the chat if you'd like to say a quick hello and let us know who you are or what organization you're joining from, and we'll be getting started in just a moment. So thanks again, everyone, and we'll get started shortly. Hello, welcome to those of you who've just joined us. We're just giving everyone a moment to find their settings in the session. Feel free to introduce yourselves in the chat, but I think we have a good number of us here now, so let's get the session started. So, hi everyone, and welcome to this half day of training on applying the IFRS Sustainability Disclosure Standards. I'm Fiona from the UNSSE team, and it's great to be here with you today. So this training program is a really collaborative effort, driven by that demand we're seeing in the market for more capacity building and support to implement the IFRS S1 and S2 standards. So firstly, I'd like to say a big thank you to the IFRS Foundation and IFC, our partners who help make this program possible. And of course, a special thanks today to the South Pacific Stock Exchange for hosting us for today's session and bringing us all together. And finally, of course, a big thank you and welcome to all of you for joining us, especially those of you who I know it's a little bit late in the day for, so we really appreciate you fitting this into your day as well. So to get the session started, I'm very pleased to say we're joined by Sheraj Obeasekera from the SPX team. He is the Chief Executive Officer. So Sheraj is just going to give a brief welcome remark to open the session. So many thanks for joining us, Sheraj, and I'll pass over to you now.
Yeah, thanks, Fiona, and good evening to everyone. Look, I think this is quite an important initiative for us in the capital market here in Fiji to bring training in an area that we think can help our market and also help our economy and the country going forward. Because, as you all know, the Pacific is quite very affected by climate change, and ESG is not an option for us, this part of the world. It's more of a need, and it can impact our communities. So, as for the South Pacific Stock Exchange, we did join UN Sustainable Stock Exchanges Initiative around July this year, not only to align with our global peers in the exchange industry, but also specifically for moments like today, where we can bring international expertise to Fiji in areas that matter. So thank you very much to SSE and that team at IFRS and IFC for bringing this training to Fiji. Listed companies in Fiji in particular are required to follow full IFRS, and the two standards that we are discussing today will be an integral part of meeting that compliance. But we've also extended it to our other stakeholders, also members of the Chartered Accounting Body here in Fiji, because this is something that can benefit the overall accounting fraternity and the profession in Fiji in terms of getting access to the parties that develop these standards. And that is access that I'm sure the participants today will find very valuable. So thank you very much once again for everyone that joined, and hopefully we can bring more trainings like this to Fiji in the future as well through SSC on ESG and topics that matter, maybe gender empowerment, and gradually progress in our journey to have effective and accurate sustainability reporting in Fiji. So it's a step-by-step process, and things like this, sessions like today, make a big difference. So thank you, Fiona, and the team, and thank you to the presenters who will be presenting today as well. Naka.
Thanks so much, Sharaj. And it's been fantastic to have the South Pacific Stock Exchange joining our initiative as well. And great to have training happening so early in the market. And indeed, as you say, we very much look forward to doing more work together in the future as well. Brilliant. Thank you so much for setting the scene so well for us there. And so from my side, I'm just going to cover a few points now to introduce everyone to the session and what we're going to be covering today before we start to get into the training content itself. So firstly, just a few practical housekeeping points. Probably by now you've noticed that as attendees you are muted in the session, but that really doesn't mean that we don't want you to take part and participate. So it's great to see so many of you introducing yourselves already in the chat box. So please feel free to use the chat throughout the session to share any comments that you might like to make as we go along through the content. Second option that you have to get in contact with us is the Q&A box. So if you have a particular question for the team, please make sure to put that in the Q&A box, and that will just enable us to track that question and respond to it directly. And then in terms of our format today, so we have a live 3.5-hour session today. We have an optional follow-on homework exercise as well, which we'll tell you about later. As I've already mentioned, one of the great features of this training is the opportunity to have your questions answered by experts on sustainability reporting as we go through the session. So please make sure to use that opportunity to ask your questions as we move along. And also, we'll very much encourage your participation in the training session as well today. We're going to be using a number of interactive features during the training, including polls and Menti. So really encourage you to take part in those interactive aspects as well to help deepen your learning, and everyone, I think, will benefit as well from the perspectives that you can all share with each other. And then finally, if you take part in our training today, you're able to receive a completion certificate as well. So we'll explain how to get your certificate at the end of the training, but you'll need to fill out a survey, which we'll share with you at the end of the session. Okay, so just to give a brief overview of who's going to be delivering the training for you today. So I've mentioned I'm Fiona from the SSE Academy team, and I'm joined by my colleague Landon as well, our SSE Project Officer. Alongside us, we have our colleague Lois Guthrie as well, a senior specialist. And then from the IFRS Foundation today, we're also joined by Robert in the capacity building team as well. And then in terms of our learning objectives for today's training session, we've got 3 key areas that we're hoping to help you advance through our training today. So firstly, we'd like to help you to understand the ISSB standards. Secondly, we'd hope to help you to understand how you can start to use and apply the ISSB standards. And finally, to help you to identify the steps that you can take to develop a disclosure plan to support your organization in adopting the standards as well. And so to help break that set of learning objectives down into some modules that we can work through in a step-by-step way, we've developed a 4-module structure that we'll be using for our training session. So firstly, we'll start with the prepare module. So that's all around building on maybe what you might already know about sustainability reporting and our understanding of how the landscape has evolved from the previous voluntary standards to reach the ISSB baseline today. And then secondly, we'll move into align. So this is all around setting the direction for your reporting, thinking about how you're going to apply and use the standards and what additional disclosures you might need to add to your reporting. Then we're going to move into implement. So this is all about how you develop your practices and systems to help you to integrate, evaluate, and identify risks. And then finally, we'll finish with communicate. So this is all around the final format of your report. So thinking about how to time what you report, where to put the information, and how to do so efficiently and in a way that engenders user confidence. And then just to show you how that content breaks down across our training session today, we'll be taking a short break in the middle of our training to allow us to refresh ourselves a little, and then we'll be working through those 4 modules in structure as we move through. I always like to mention here that Module 2, Align, where we really get into the detail of the standards, is a large one, so that's a big bulk of our content in the middle of the session. And then just to mention a few things that are key to keep in mind throughout the session. So we're going to be working, as you say, through the presentation that we're using today, but you'll be able to download this presentation as a slide handout from the resources section of the SSE webpage, which my colleague Landon will share with you in the chat. So if you go to that page at the bottom under resources, you'll be able to download this presentation, and that will give you links to all of the resources that we're discussing today. You can also find in the same place the homework assignment that we're going to be discussing shortly, and you'll also find there after the session the recording of the training as well. And I mentioned there as well that homework assignment. So as I've mentioned, this is an optional activity. It's not mandatory to complete this, but it's a way that you can potentially put into practice what you learn from the training program. So this is available, as I've said, from the page that Landon's just shared the link to in the chat with you. And that homework assignment is really focused on helping you to develop your organization's own disclosure plan. And so thinking about how you can work with your colleagues to put into place what you need to get aligned and implementing the standards. And then finally, on the resources side of things, just to also mention that the SSE has developed a toolkit of different resources to support you on sustainability reporting. And these resources have all been developed to align with and support the adoption of the ISSB standards. So we have our model guidance, which we'll be referring to a few times through the training, and also some particular tools that can be helpful for you. So for example, a gap analysis checklist to help you build out your reporting processes and understand what's missing. So be sure to take a look at those as well. Okay, so to get us warmed up, we're using our Menti for the first time today together. So we'll come back to Menti a couple of times through the session for other forms of interaction. So I'd encourage you to get familiar with it and find your way into the system now. So my colleague Landon's just shared with you there the link to access Menti. So if you click on that link he's just shared in the chat, that will take you straight to the question that I am starting with today. But what I'll do as well is I'll share my screen so that you can also see another couple of options that you have for how to join us in Menti. So firstly, you can use that code as we've seen at the top of the screen as well. So another option, go to menti.com and enter that 8-number code that you see at the top there. And then a final option that you have is to use that QR code that's visible on the screen now as well. But the simplest option probably is just to click the link in the chat, but we'll share that again a few times in case anyone needs to come back to that. So our first question, just to get us started, is to get a sense from everyone really on what you're hoping to get out of the training today and what brought you here in particular. So thanks for those who've already shared their thoughts here. So I'm seeing sustainability. So great. I think you're in the right place there. Knowledge, empowerment, practices, interest, learning, compliance, the future as well, as you mentioned, exploring IFRS, learning again, driving transparency, indeed, enhancing reporting, thinking about reporting requirements. Fantastic. Thanks, everyone. Great to know lots of different perspectives that we're coming at things today, but hopefully all things that we can help you focus on and build on as we move through our training today. Brilliant. Okay, and then our second question, thanks for that first response there, is just to get a sense of those 3 different learning objectives that we set ourselves for the training today, where your current understanding and comfort is on those 3 aspects. So you can use the sliding scale that you'll be seeing now to let us know from the left-hand side, maybe being brand new to these topics and just getting started, to the right-hand side, maybe being quite familiar and really an expert already, and anywhere in between, of course. You can let us know on that scale what your current comfort is and experience on these 3 different areas of explaining to your team what the ISSB is, on using the ISSB standards, and on developing a sustainability reporting strategy. Just give you all a little moment to respond to that. Great, thanks for those who've responded there. So it looks like overall, maybe we're on the middle to lower end of comfort on these areas at the moment on average, which of course is very understandable and what we're hoping to help you to improve and advance in our training today. So you're in the right place to hopefully help you advance those different areas. Okay, thanks for sharing. I'll just take us back into the slide presentation now. But I'd recommend keeping that tab with Menti open in the background because we'll come back to that same link later in the session for some more exercises. Okay, so that kind of covers our opening content, and I'll now be moving into our first module. But before I do, I just have a quick disclaimer that I'd like to share with you all. And this is really just to be clear about how we're going to be using examples in today's training session. And so, what we want to say really is that we're sharing examples today because we know it can be helpful to see real practices of what companies are doing. But these examples shouldn't necessarily be seen as the right or indeed the best way to take forward these topics. Of course, your company will need to do what's right for your circumstances. So please do keep that in mind when we talk about the examples we're using today. Okay, and with that, then I'll be starting, as I said, with a brief overview of our prepare module. And here we're starting on really building that solid foundation of knowledge and thinking about maybe what you could already know about sustainability reporting and standards that you might be able to build on here. And in this unit, we like to cover three key aspects in particular. So we'll start with purpose, and that's really thinking about the case for sustainability reporting, including what the market and business case for it might be. We'll then move into landscape. And so this is all about how the reporting landscape has evolved and including how it's becoming simplified as well. And then finally, we'll finish with introducing the global baseline. So explaining the core concepts and requirements that form the IFRS S1 and 2 standards. Okay, so getting started then, I'll be getting us going with thinking about why. And so looking at the purpose of sustainability reporting and what the particular drivers might be for organizations to be focusing on this. And so to get us started, I'd like to hear from you all about what your key drivers are for focusing on sustainability disclosures. So you can select as many of these options here as are applicable for you, or feel free to let us know in the chat as well if maybe you have some other drivers that we haven't identified here. But the possible options here would be maybe the regulatory compliance requirements. Maybe you want to share your own management and organizational objectives with your stakeholders. Maybe there's a bit of peer pressure and it's the competitor expectations or societal expectations on you. Maybe it's something your investors have asked for in particular, or maybe, as I say, you're not reporting yet and you're just getting started on the journey, and that's no problem as well. And as I said, feel free to let us know if we've missed any drivers that are relevant and important for you as well. Great, thanks everyone for taking part. I can see the numbers taking shape in the poll, so I'll just give you a couple more seconds and then I'll end the poll and share those results with you. Perfect. So I'll share that with you now. So it looks like for most of you, regulatory requirements is the top driver, but also quite a lot of you indicating a few other reasons as well. So maybe the desire to share your own objectives or the interest of your investors. So that's always really interesting. But it does seem like quite a healthy proportion as well are quite new to sustainability reporting and just getting started. So hopefully in this session today, we can help you to demystify some of the key concepts and help you to figure out what your best next steps should be. Great, thanks for sharing that with us, everyone. Okay, so talking about a couple of those drivers, one that I know a number of you mentioned was relevant for you there was that interest from investors in this information. And so that's a trend that we do really see globally as being quite relevant across all markets. So this data set that we're seeing here is the number of signatories to the Principles for Responsible Investment. And we now have over 5,000 signatories to these principles, which, as you can see, was a big growth compared to the position we were in perhaps 5 years or so ago. And so, what is it that's really driving that big growth in interest in responsibility and sustainability from the investment community? Well, I think the key point that we want to emphasize here about what's driving that interest is that investors are really very concerned or interested in understanding more about the financial effects of sustainability information. So, while some investors may be focused particularly on impact, actually, for a lot of investors, understanding sustainability is increasingly becoming fundamental to how they assess investments. And so this data that we're seeing here comes from a study of retail investors, which was conducted by Morgan Stanley. And in this study, Morgan Stanley found that the top driver, at least of these investors, that was focusing their interest on sustainability was actually the financial performance of sustainable investments. And so you can take a little bit of a look at this study in the handout by following that link on the screen if you're interested to know more. But I've mentioned there around financial performance. And so that's probably a good opportunity just to help ensure we're clear on a few key terms to start with. So it's important to remember today that in particular, we're talking about disclosing financially material sustainability information. So later in the workshop, we'll go into more depth about what we mean by materiality and how to determine that. But what we want to be clear about from the start is the sorts of financial effects that investors are looking to have more information on here. So if we start with effects on a company's financial performance, this is often seen in the statement of profit or loss, showing income or revenue and expenditure. And this is where sustainability related risks and opportunities can potentially have a financial effect. For example, by changing the revenue mix or total revenue of a company. For example, if demand for its products and services change, or perhaps if its production capacity is disrupted, as an example as well. And we could also see substantial changes in expenditures. For example, if operating costs increase due to energy prices increasing, or perhaps if there's a need for greater investment in research and development to capitalize on sustainability opportunities as well. And then the other thing that you'll hear us talking about today are effects on a company's financial position. So let's also look at what that means as well. So we usually see a company's financial position reflected on its balance sheet. So for example, a company could also experience changes here that could impact financial position. So for example, there could be changes in assets or liabilities due to climate or sustainability issues. We could see changes to portfolio value, or we could even see write-offs of certain assets that maybe are damaged or need to be repriced. And another financial effect that we'll see documented is changes to financing and the costs of capital. And this can include, for example, changes in insurance premiums, perhaps if they're increased due to climate risks, and as well as making use of new financial structures, such as green bonds or social bonds. And so before we move into the next unit, I want to flag two really important concepts for sustainability related risks and opportunities that are quite essential to our understanding of them. And these both connect to risk. So as you can see here, this data is from the Global Risk Perception Survey from the World Economic Forum, which you might be familiar with. And this shows really how risks can evolve over time. So the risks that may pose a significant threat 10 years from now might not be those that are high on our mind on a much shorter term time horizon. But what's quite important when we're thinking about sustainability disclosures is that we're preparing for those risks that we're expecting to see arriving on a longer term horizon. And if we're taking steps now to prepare for those risks, it might be that we need to invest today in new practices or processes, perhaps to mitigate negative impacts or to increase our opportunities and our ability to capitalize on those. And that might mean that if we have to take that action today, we could see financial effects much earlier than when the risk itself is expected to materialize. So that's something to keep in mind for our training today, the aspect of time and how that can be a little bit different for sustainability risks and opportunities. And another important concept to flag here is the interconnectivity of sustainability related risks and opportunities. So this is another visual taken from that World Economic Forum report. And as you can see here, it really shows how interconnected different types of ESG risk are. So whilst many people might think of the different ISSB standards of S1 for climate and S2 for other sustainability topics as separate things, of course, in practice, all of these issues are very much interconnected. And so when we're preparing disclosures on one topic or a particular standard, we need to do our best to think still about that interconnection between these issues in how we manage this within our organizations and how we report on it as well. Okay, so that gives us just a little bit of an overview of the purpose and drivers behind reporting. And so I'll pass over to Lois now, who's going to get us started on the landscape module.
Thank you, Fiona, and hello, everybody. So we've looked with Fiona at why sustainability-related disclosure is important, and in this section, we're going to look at how reporting standards have evolved in the context of the existing landscape. Before we do that, though, could we ask you via a Zoom poll, what frameworks are you currently using for your sustainability reporting and disclosure? So please tell us via Zoom whether you're using the Global Reporting Initiative Standards, GRI, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, perhaps regional standards, or others. And please do indicate in the chat if you're using other types of standards, and you can choose as many as apply. Maybe you're using none. Please tell us if that's the case too. Give you one more moment to tell us what frameworks you're currently using. Lovely. Let's have a look at the results now. So as you can see, most of you are not currently using a framework. So 57% said none at the moment. Then those of you that were using frameworks, integrated reporting is the most widely used, followed by Global Reporting Initiative standards, some using SASB, some using regional standards. So hopefully today we'll be able to help you understand what frameworks are available, and in particular how the ISSB standards could help you. But thank you for sharing information about frameworks you're currently using. Let's go on to look at the IFRS Foundation, which is the organisation that has developed the international sustainability standards we're going to look at today. The foundation itself is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, you can see that the foundation hosts two independent standard-setting boards. The International Accounting Standards Board was formed in 2001, and the financial reporting standards that the International Accounting Standards Board developed are in place in 140 jurisdictions around the world. The sister organisation, the International Sustainability Standards Board, or ISSB, we'll be talking about today, was formed in 2021 and released its first two standards in 2023, following strong market demand for its establishment. Because these two organisations are within the same foundation, they work closely together and ensure that their standards complement each other. The work of the standard setting boards is monitored by trustees. They provide the governance, and they in turn are accountable to a monitoring board of public authorities. How did these standards come to be then? Well, they developed from the work of many organisations. This looks like a confusing picture, but one thing to take from this slide is it is actually a picture of harmonisation and simplification. So when the IFRS Foundation formed its standards, they took and consolidated into their work the work of the Climate Disclosure Standards Board, the Integrated Reporting Council, and the Sustainability Accounting Standards Board. So all of that work was consolidated into the ISSB standards. Those of you that know the TCFD, the Task Force on Climate-Related Financial Disclosures, their work has ceased now. They've disbanded, and the IFRS Foundation has taken on responsibility for their work and used the TCFD recommendations as the basis for the standards we'll be talking about today. The Transition Plan Task Force work is now also the responsibility of the IFRS Foundation to the extent that it covers disclosure. CDP has aligned its climate questionnaire with the ISSB standard on climate, IFRS S2, and GRI and ISSB are working together to ensure that their standards are jointly aligned and contain common disclosures. So the arrows show us that this is a picture of harmonisation and simplification. So having heard about this, what do you think is the answer to this question? If you could tell us via Zoom, please. Companies that are currently disclosing using the recommendations of the Task Force on Climate-Related Financial Disclosure automatically comply with the ISSB standards. Do you think this is true or false? Just give you a minute to think about this. Now that more than half of you have answered, let's end the poll and look at the results. And as you can see, you're very evenly spread, and I can completely understand that. The correct answer is false. So well done to those of you that answered false, and I'll explain the reason for that now. Although the TCFD's work was consolidated into the ISSB standards, there are some differences between the TCFD's work and the ISSB. So we just heard that the TCFD culminated its work, but there are some small differences between TCFD and ISSB standards. There are three main types. First of all, S2 uses different wording, but to capture the same information. Second, S2 requires more detailed information than the TCFD, and these could be things like additional information about whether and to what extent carbon credits are used to satisfy climate goals. And thirdly, S2 asks for some additional information and gives additional guidance. And an example of this is on the need for companies to consult sector-specific standards when making their disclosures. So all these differences are explained in the comparison document you see on the left, but we've gone through the three main types of difference. The point for you, though, is don't assume just because you're using TCFD that you automatically comply with ISSB standards. So what was the ISSB's goal? It was to set a global baseline for sustainability information that would provide consistent and comparable sustainability disclosure across capital markets. And the Foundation is working with jurisdictions around the world and other stakeholders to achieve this. However, it recognizes that in addition to the global baseline that we see in the standards, regulators, stock exchanges, and others might want to ask companies to disclose further information. And they can ask for this by adding their own additional building blocks that are tailored to elicit jurisdiction-specific information or information to meet broader stakeholder needs, information needs, such as we would see in GRI standards. So taking this building block approach reduces the need to duplicate information. So we've got that globally consistent baseline of disclosures, but it still allows you to report additional information based on standards like the GRI standards. This approach has had global backing. Well, the comprehensive global baseline is in the standards. IOSCO, which is the International Organization of Securities Commissions, has endorsed the ISSB standards and asked their 130 members how they can incorporate the standards into their regulatory frameworks. We see new audit standards developed by the International Audit and Assurance Standards Board to support assurance of sustainability disclosure. And as we said before, the ISSB is working with jurisdictions around the world who are planning or preparing for voluntary or mandatory adoption of the standards. And of course, webinars like this are part of the effort to work with stakeholders around the world who are even planning to voluntarily adopt the standards. So let's hear a bit more about the standards now from our colleague Robert, who's going to start introducing us to the standards. Over to you, Robert.
Perfect. Yes, thank you very much, Lois, for this introduction. Yes, indeed, we'll be now moving to the next section, next module of this training, and I will provide you a brief overview, introduction to the IFRS S1 and S2. So for now, we covered the business case and the market case, and now let's delve into the standards themselves. So, but before we get started, let's clarify a few key terms we will use throughout. So we'll hear us today saying quite often sustainability-related financial information. So what does it mean? That means that it's simply information about companies' sustainability-related risks and opportunities that's useful to investors. So things like climate, biodiversity, or social issues, if they could affect a company's financial outlook. We will also mention general purpose financial reports. So that includes the financial statements, but also the management commentary, sometimes called the management report or strategic report, depending on your jurisdiction. So this is to clarify on the terms we'll be referring to today. And now it's an important slide, and probably you might be already familiar with these categories. If you were familiar before TCFD, then you should also recognize these. So the ISB standards are structured around the same four core pillars: governance, strategy, risk management, and metrics and targets. Each of these areas has a specific disclosure requirement, and we will go through each of one later. But if you haven't already, I recommend downloading the standards and reviewing the detailed guidance. All right, so that was the intro to the topic, and then let's start with IFRS S1. So first of all, to start with, I would say don't worry. It might sound technical at times, but much of it builds on the concept you already know. So IFRS S1 sets out the general requirements for disclosing sustainability-related risks and opportunities, regardless of the topic. So not just the climate, but also social or biodiversity risks if they are financially relevant. It's, as mentioned before, it builds on the TCFD framework, and also points preparers to the SASB standards and other guidelines to help identify relevant issues and metrics, especially at the industry level. This makes the disclosures more tailored and meaningful. And importantly, IFRS S1 is designed to work alongside existing financial reporting standards, so it should be compatible with any accounting requirements, your local GAAP requirements. All right, so that was a really short introduction what IFRS S1 is about. Now let's move to S2. IFRS S2 is focused specifically on climate. It builds on S1 but zooms in climate-related risks and opportunities like physical risks. So you might think about floods or droughts, and transition like risks like policy changes or low carbon technology. And similar to the S1, it also incorporates all the TCFD recommendations, but goes further. For example, it includes requirements on greenhouse gas emissions, scenario analysis, and industry-specific metrics. Again, SASB industry-based guidance is essential here. It helps identify which metrics are most relevant to your company's activities. So what it states, preparers must refer and consider the applicability of the industry-based guidance on implementing S2. As we said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So that was a short intro of the two standards, and now let's see how they fit together and how they relate with each other. So S1 and S2 aren't optional add-ons, and they are designed to be used together. So even if you're only reporting on climate this year, you still need to apply IFRS S1 because it sets out the framework. It's defining materiality, requiring connected information, and outlining how to present disclosures that are useful to investor decisions. All right, and within the standards, there are some key terms which we would like to explain right now. These are the underlying concepts that guide how information should be disclosed. So the standards required a fair presentation, and it means a complete, neutral, and accurate picture of sustainability-related risks and opportunities. So the companies must fairly present a complete set of sustainability-related risk opportunities. And so the fair presentation requires disclosure to be faithfully represented. As I mentioned, to achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. And the third and another important concept is connected information. And we saw earlier when Fiona was explaining how different risks are often interconnected. So the ISB standards require companies to clearly identify key connections between risks and opportunities, connections between the four content areas we discussed before, and also connection between sustainability-related financial disclosures and the main financial statements. Right, so this is to present you with this key conceptual foundations and how that work in practice. And I'll turn to Lois, who will present to you an example. Over to you, Lois.
Thank you, Robert. Yes, as this is the first example that we're having in our training today, I just want to remind everybody of the words that Fiona gave us earlier, that the examples we show you today are not necessarily best practice. They are here to illustrate certain things and to inspire you. So That's the context in which we give you these examples. The first one we're going to look at today here is from the Operating and Financial Review section of BHP's 2024 annual report. And BHP is a large global mining company. And what the extract tells us is about the connections between the company's business, strategy, climate risks, capital alignment, and capital allocation. So the first paragraph tells us that climate risk assessments and climate scenario analysis have been carried out by the company, but rather than being looked at separately, they've been integrated into the company's strategy and treated as a sensitivity in their capital allocation process. So they're connecting what they found in their climate risk assessment and scenario analysis with their plans for capital allocation. And of course, they're also aligning this with the implications of there being a rapidly decarbonizing global economy. In the second paragraph, they tell us that some assessments are still in progress. So in particular, they're looking at studies to assess the effect of future physical climate-related risks on the company's operations, productivities, and costs. And they tell us that they're going to use these results to inform updates to their risk profile, including new risk management activities, to inform their corporate planning and identify areas where they should focus their assessment of new or strengthened controls or adaptation responses. So you can see that they're planning to weave the results of that physical assessment into lots of different aspects of their business decision making. In the light grey text at the bottom of the extract, the company directs readers to places where they can find further information on the impacts of climate-related risk on operational activities, GHG emissions across the value chain, their financial statements, production revenue and expenditure. So you can see that the implications of climate are very much embedded into and connected to lots of different aspects of their corporate decision making. Back to you, Robert.
Great, thanks, Lois, for this. Yeah, we'll be moving now. We have another Zoom poll. So this should appear on your screen. And this one is about the connected information. Great, hit there. So yeah, as we talk about, as a key concept in IFRS is one. And the things the standards emphasize is that sustainability-related disclosures should not be siloed, it should work together. So the question is, what types of connections are important to consider? And please select here all options you think apply. So we have three options. We have a connection between four core pillars: governance, strategy, risk management, and metrics. We have sustainability-related financial disclosure and financial statements as two categories. And the third one is the sustainability-related risk and opportunities. So according to standards, which of these we should consider connections in order to meet the requirements of the standards? As I'm seeing, you are, yeah, we're reaching more than half of you participating in the poll, so I'll end it right now. And of course, most of you are indeed correct. So the connections need to or should be considered between all these three different categories of the topics. So four core pillars: financial information and sustainability disclosures, and also between the risks and opportunities. So well done to ones who answered that. All right. So the next topic, really important and should be familiar to anybody who has an accounting background. Finally, the standards are built on a concept of materiality that is defined by the IFRS foundations. We will go into this in more detail later, but just to highlight for the moment, that we'll be referring to the material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision. Right. So this is about materiality, and this concept is the same as it is in the accounting standards. So there's no difference there. And then on this slide, we would like to go to point you to some additional guidance and materials which might help you to navigate the topic. So during the ISB consultation and exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources, and also those in emerging markets. So in addition to the standards and application guidance published in 2023, a number of educational resources were also published since then, and others have followed. So including IFRS Knowledge Hub. So please refer to this database. We're also in the process of gathering examples and case studies provided by our partner. The SASB standards were aligned with the IFRS tools to help preparers seeking industry-based guidance, and the FSA credential was also updated with more planned to come. I should also note that IFRS Foundation Capacity Building Program launched at COP27 is a key part of support to preparers. And the training we're having right now is one of the most important deliverables of this program. Great. We will have now another Zoom poll. It might be slightly more tricky. So let's see how you work on this. So imagine this. Water is a vital input to your business, but ISSB standards don't currently have a specific standard in water. So what should you do in this situation? So please take a moment to read the options and choose the one that seems the most appropriate. So we have 4 options. So one of them, the first one is do not disclose anything about the water. There's no standard, no need to disclose. B, consult the sources of guidance listed by ISSB. The third one is engage a consultancy to help. And D, copy your competitors' reporting. So let's see how you're gonna do on this one. And I see most of you already took part in the poll. And indeed, most of you, well done, chose rightly. So you should consult the source of that guidance listed by the SSB. There's no specific water standard at the moment. But there are other standards which ISSB is recommending or actually requiring to refer to, and that you should follow this. Engaging a consultancy might be actually an option. That might be helpful. So that will be an alternative, not alternative, but maybe just a way to help you, to guide you through this process. So B and C will be viable options. Of course, do not disclosing anything about the water. If there's material, that would not be the right choice, and it's copying your competitors' reporting also would not be helpful here. All right, so with this, we will now turn to Fiona, and she will provide a summary of the module 1.
Great, thanks so much for that, Robert, and to Lois as well. So as you say, that wraps us up now on our first module. So I'm going to take a few minutes to recap with you some of the key things we learned, and then we're going to do a little bit of an exercise in Menti to reflect on this topic. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway that we're hoping you leave this workshop with is that there are really important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. So ultimately, if you're putting all of this effort in to disclose this information publicly, but you're not necessarily thinking about how you could use it for your own strategic decision making, then you're really missing an opportunity and wasting some time and resource. So important to keep that in mind. And also, if you have operations in difficult to abate or high impact or risk exposed sectors, it's likely that your competitors could be starting to disclose these risks and explain how they're managing them to investors or how they're capitalizing on opportunities. And that's going to then leave your investors wondering why you're lagging behind and might start to affect your ability to raise capital. Next, we then looked at the evolution of sustainability disclosure standards and the formation of the ISSB, with that aim to really simplify the reporting landscape. But when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, there, Robert introduced the standards themselves and the important concepts that you need to understand in order to use them correctly. And a key point that I want to reiterate here is that the standards and the guidance that come with them are very much designed to meet the needs of investors. And therefore, they're heavily focused on those prospects that we talked about at the start of the unit relating to effects on financial effects and effects on financial performance and position. Okay, so to get into then our reflection exercise, with each of these exercises, what we're trying to do is help you to build up the components that will go into the disclosure plan that you can develop through your homework assignment. And so in this first exercise, what we'll be focusing on is thinking about what the objectives and goals of your sustainability reporting are. So we think that it's really useful to be clear at outset on what you're trying to achieve with your sustainability disclosures, or how you're maybe planning to adapt or iterate what you already report. So here you should be thinking about, are there particular reporting requirements that you're trying to meet? Are there the needs of particular stakeholder groups, perhaps, that you're looking to satisfy? And you'll also want to think here about what the degree of changes that is needed. So obviously, if you're brand new to reporting, it may be that your goal needs to be, to do quite a lot to put in place some of the core concepts. However, if it's perhaps the case that you already do some reporting, your goal might just be to iterate and evolve what you're already doing. So what we'd like to do is just take a moment to reflect together on what your objectives are so far. With all of these questions, there's no right or wrong answers here, and we're not going to hold you to what you say, but hopefully a useful opportunity just to reflect immediately on what we've talked about so far and what your perspective is on this topic in particular. So I see a few people have already shared their responses, which is fantastic. And the rest of you, feel free to take a little bit of a moment to have a think about what your personal objective might be as well. And we'll take a little bit of a look at some of the responses that we've had in together. So from those who've responded so far, someone has mentioned that they're already disclosing sustainability information to enhance transparency, and they're looking to demonstrate their commitment to sustainable development and support informed decision making. So a nice balance there between transparency, taking action on sustainable development, and helping to inform your internal decision making as well. Someone else has mentioned around building trust with stakeholders, thinking about your brand reputation, how you manage risks, achieve operational efficiency, attract investors and talent as well, and ensure regulatory compliance. So again, sounds like quite a rounded approach where you're aiming to balance those different objectives. So indeed, of course, for many organizations, you're not going to have one single objective here, but it's about taking a comprehensive approach. But equally, for some of you, it might be that there's a higher priority on certain aspects, and that's okay as well. So someone's here mentioned as well, providing more information about the company's sustainability risks and opportunities to investors so they can make an informed decision considering providing resources. So a more investor-focused response, which indeed obviously is what the IFRS S1 and S2 standards are very focused on. So should set you up well on that objective. And then someone's mentioned around understanding the benefits of ISSB, having a better view in reporting for board and compliance requirements, providing transparency, enhancing accountability, and fostering informed decision-making for all stakeholders. Fantastic. So indeed, that's a good point. So it's not just about your own decision-making as an organization, but actually how you can inform the decision-making of your stakeholders and in particular investors as well, which I see a few people have mentioned here as well, which is great. I see as well a few responses that are picking up on, I guess, risk management. Both someone here has mentioned risk management and someone else mentioning around extreme weather. So indeed, using the opportunity of the exercises to assess risks for reporting purposes, to think about how you can support your organization's own long-term resilience, better manage long-term risks and opportunities from sustainability is a very good objective to have as well. Okay, let's see what else we've got. Lots of great responses. Thanks, everyone. Some people are saying maybe initially compliance and delivery and then subsequently improving strategy. So maybe that's a good way to think about it, indeed, having a sequencing. So, you know, your top priority in the immediate term could be to make sure that you're compliant and that you get that baseline in place. And then, as you say, over time, it might be that you can work to use that information internally to improve your strategy and decision making and build trust. So a good way to think about maybe how you sequence and prioritize your different objectives there. Great. So a few more responses that show a good balance of different factors, which is great. Some people mentioning specific aspects around maybe reputation, investors, accountability. Great. Someone's mentioning as well informing users of financial statements on the work that you've been doing. So indeed, it might be that actually you're not talking enough about what you're already doing about sustainability, and it could be that, you know, putting out more disclosure here can be helpful. And I think maybe the users of financial statements point there is helpful as well. So thinking about both how you can talk about your sustainability risks and opportunities and its connection to your strategy, but also that connection to financial information too. That's often one of the tricky parts, and we'll be getting into that a bit more later in the session, but it's a good thing to be keeping in mind and aiming to achieve indeed. Great, lots of great responses here. Thanks, everyone. It's always great when we have lots of ideas and input, because I think we all learn a lot from what we can share with each other as well. Great. Just see if anything, lots of similar versions of things. So I'll just see if there's anything coming up that's a little bit different, but equally, I think these are all very good answers. So that's not a criticism at all. And then someone's mentioned about the ability to continue as a going concern. So again, connecting to what you need to do for financial accounting purposes is a good point to highlight here, and really demonstrating how actually inherently all of this information is very relevant to what you already need to disclose for your accounting purposes. So enhanced decision-making and compliance, enhancing transparency. Yep, great. And then someone's also mentioned about performance improvement and alignment with global goals. So indeed, that might be part of your objectives here, obviously to show your own contribution as an organization, maybe to the Paris Agreement in terms of emissions reduction and climate resilience, or maybe other goals as well, such as on human rights or nature and biodiversity. So we'll go into a little bit more about some of those considerations later, but indeed it can be useful as a framework for comparison and for your investors to indicate how what you're reporting is aligned to those sorts of objectives. Okay, great. Thanks, everyone. Lots of really good responses here. Okay. I think we'll close off there. Lots of really good answers, and I think demonstrates what we always love to see here, which is that great balance between not just complying and maybe putting information outwards, but thinking as well around how you can really use that information internally for your own purposes. So I think you've really highlighted here a lot of the things that we would have recommended. And another thing I think several of you have highlighted in your responses that we would recommend as well is to think as ahead and into the future with this too. So thinking about how you can use this to build long-term resilience and build a business approach that's more flexible and adaptable to how things might develop in the future too. Brilliant. Thanks everyone for sharing that. So I will reshare the slide presentation now, and I'll pass back over to Robert, who'll get us started on the Align module.
Yes, great indeed. Thank you very much, Fiona. Yeah, we'll be moving now to the second module of this training, Align. So now that we have introduced initial concepts, we'll dive into how to apply the ISB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well peer practices and your leadership objectives. So in order to understand how to ensure your disclosures meet global standards, we'll look into two concepts in this unit. The first and the main focus on this unit will be how to apply the standards to achieve global baseline for disclosure. And once we cover this, we will also discuss how additional disclosures fit. So to begin, we'll focus on how to apply the SB standard as a global baseline. And let's start with the first core content area, governance. These include aspects that relate to the governance body in your company and how management is applied. So how we're gonna do it for each content areas, we will discuss questions that you would ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as a part of gap analysis. So if you look at the governance and management requirements, we can see that the several are fairly qualitative. So this area of governance, it's something which is relatively straightforward, and we see from other areas. So that should be fairly easy. So the question you should ask here are, first of all, which bodies are responsible for the oversight and management of processes, controls, procedures of sustainability-related risks and opportunities? For example, is the management responsibility delegated to a specific role or committee? Secondly, the question you want to ask would there be how and when do those bodies, those governance bodies, get informed about sustainability-related risks and opportunities? Thirdly, how these issues inform strategy? How do they inform decision-making and risk management? So this could also include setting targets to manage sustainability-related risks and opportunities. And then finally, whether the progress against these targets is linked to executive remuneration. So for more information, you can make use of the SSE checklist tool. But remember, if it's not a replacement for reading and using the full ISB standards. And now we will look at a couple of examples how the governance can be applied in practice. So again, Lois will present it to us. Thank you.
Thank you, Robert. Yeah, so we're looking here at two examples about how different companies have structured their governance model, and in particular, the sustainability aspects of their governance model. So this first example is from a company called Yara, which is a global crop nutrition company operating in 60 countries. And you can see that this is a very highly integrated model with responsibilities for sustainability through their sustainability network. You can see that right at the bottom there, embedded across lots of different business functions, including risk management, health, safety, environment and quality, HR, and global climate and energy. The sustainability governance team that you can see in the light green box on the left there, they have a direct reporting line to the Chief Financial Officer, and they are responsible for sustainability performance and reporting, supported by the Sustainability Network and the other teams that you see here. The CFO then in turn reports up to the Board, Audit and Sustainability Committee. The arrows that you see here are used to identify how information flows between different parts of the organization and how inputs take place between different governance bodies in the organization. So as you can see, lots of connections and integration. We also see where and how there is oversight of information, where there are reporting lines, and importantly, where there is available competency or expertise to help with the governance of sustainability activities and reporting. So there are lots of cross-cutting input activities that are taking place, and many of these originate from the sustainability network. Let's look at another example. This comes from Toyota, which is, I'm sure you know, is a car manufacturer. It's an extract from their 2024 report. And here they're explaining the role of the Sustainability Committee within the company's governance structure. Now, the Sustainability Committee is one of the business execution committees that reports direct to the President and Board of Directors, so that's its reporting line. This extract shows the frequency with which the Sustainability Committee meets, about once a year or as necessary. It shows who chairs the committee, its members, and its main agenda. So in this case, the Sustainability Committee is chaired by the executive in charge of enterprise risk and compliance management. So different from the Yara example where reporting was into the CFO. We see again, though, that the members of the committee are taken from a wide range of different functions within the organisation: HR, accounting, technical executives, board members, etc. So again, lots of cross-cutting input into the Sustainability Committee's work. And in the final row, we see the agenda of the Sustainability Committee. It has to approve action plans on sustainability, encompassing CSR and materiality and targets, and it evaluates activity results. It determines the direction of the company's approach to sustainability, all taking account of the opinions of stakeholders and social trends, and it revises the sustainability policy, and in the report itself they link to that policy using a QR code. So there are two examples on governance, and with that I'll hand back to Fiona to take us through the strategy core content area.
Great, thank you for that, Lois. So hopefully those examples help to make governance clear. And as we said, we're now moving on to talk about strategy. So strategy does have a few more disclosures to include than governance, but it is also really where companies can start to see the benefits from capitalizing on sustainability opportunities and being prepared for the risks as well. So there are three high-level areas that we'll focus on in this area. So this is identifying and disclosing the risks and opportunities, reporting on the effects of these risks and opportunities, and then finally resilience. So let's take a step through each of these in turn. So once we get started here, IFRS S1 and S2 disclosures on strategy are helping users of reports to really understand how the company is managing its sustainability-related risks and opportunities. And if we look first at the requirements on reporting risks and opportunities, here are some of the questions you'll want to be asking yourselves internally. So you want to be thinking about basically what the risks and opportunities are, what the effects of those will be, and over what sort of time horizons you might expect those effects to occur. And the last question in particular here focuses on climate risks as well. So this is where investors want to understand the different types of risks and opportunities that companies may be expecting to see. And so this is where many organizations draw from the categories developed by the TCFD of physical risk and transition risk, which we'll talk in a bit more detail about later. And overall, the standards for S1 and S2 and the guidance that come with them are asking companies to identify and disclose these different risks and opportunities. And they recommend as well to make use of industry-based guidance and the SASB standards to help you to disclose and consider the particular types of risks and opportunities that might be applicable to a given topic or to your sector as well. So taking a look at another example here, we're using this example from Mondi to show how they've identified and disclosed their particular risks and opportunities. So Mondi is a packaging and paper company which operates across Europe, North America, and Africa. And in the left-hand side of the extract, we see which risks the company has identified overall for its organization and how these risks align with four key categories of strategic, financial, operational, and compliance. For each risk as well, they identify who the delegated risk owner is, and then in the detail of the report, you can read about the particulars of each area of risk, which they describe in more information. And then as they've identified climate change as one of their organization's strategic risk types, in the right-hand side, they then go into more detail to break out those different types of physical and transition risk, and also climate opportunity that they expect their organization to see as well. So shows how they've just summarized and broken out those different risk types in their reporting. And so another aspect of risks and opportunities identification that needs to be disclosed brings us back to what we started at the beginning of the session by discussing, which was all around time and time horizons. So you might remember when I introduced this earlier that we discussed that time can be quite different when we're talking about sustainability disclosures. So let's be clear what we mean by time horizons. So here the standards ask you to identify within what time horizon any material effects are expected to occur. And how an organization defines short, medium, and long-term time horizons, as they're asked to use here, will vary between companies because ultimately it's going to depend on a number of different factors. For example, what the organization's investment and business cycles are, what its strategic planning horizons and capital allocation horizons are, maybe the lifespan of the assets that it operates, or the assessment periods used by its investors as well. So what you need to do is identify what are relevant time horizons to use for your organization. But the most important thing is that you disclose in your reporting what those horizons are and provide a quantitative definition, because otherwise your investors won't necessarily know what you mean if you say short term or long term, etc., without that definition. So now to the second group of disclosures in strategy. The first part there was about identifying those risks and opportunities. And now we're talking about disclosing what the exact effects of these risks and opportunities are and where those occur in the business. So to start with tackling these aspects of the standards, companies might want to ask themselves questions such as describing what the effects are and understanding how they plan to respond and adapt to those different effects. And again, this is where we know an example can be helpful to bring some color to what we're talking about and see how one organization has approached this. So this example here comes from the global chemical company BASF in their annual report. And what we want to highlight in this example is that they've explained in their reporting how the different sustainability risks and opportunities they've identified affect the organization across its business model and the different areas of its value chain. So with all of these disclosures, obviously it's hard to get all the information onto one slide, and we know it can be a bit small, but this is just a summary diagram. So I'd recommend reading the report itself if you want to better understand this. But this diagram, I think, is helpful because it shows the company's overall sustainability strategy and how it plans to take actions to transform the way its business model operates across its different upstream, operational, and downstream activities. So, for example, in the upstream area, they're very much focused on sourcing more renewable materials from their suppliers and working with their suppliers to develop new bio-based materials as well. Then within their own operations, they're putting a focus on operational efficiency to reduce their own emissions and to run their processes in a way that uses less energy. And then finally, if we look to the downstream, they're focused as well here on what they call their sustainability solution steering approach, which is all around basically how they work to develop different products and services that respond to the needs of their customers and really deliver what they want. So it kind of shows really, where they're taking action across each area of the value chain. And so what they also say in the commentary in the report is that they really want to target growing their sales revenue from sustainable and more circular products as well. So it sort of really shows how identifying and managing these sustainability risks and opportunities is actually starting to be a strategic differentiator and imperative for their business as well. So sometimes we know that an obstacle that companies can face when they're reporting on these effects from the risks and opportunities is what sort of detail needs to be disclosed. And in particular, whether quantitative information needs to be reported or just qualitative. And in that example that we just looked at there from BASF, most of the information was more qualitative. But what about quantitative information? So a company is expected under the S1 and S2 standards to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability risks and opportunities. However, the standards do also provide criteria for when only qualitative information is required. So, for example, using only qualitative information about the financial effects is allowed if a company can't separate the effects of a sustainability risk or opportunity from other effects. Secondly, if there's a high level of measurement uncertainty and it's just simply not possible to quantify this information. And finally, as well, if the company itself doesn't yet have the skills, capabilities, or resources to provide that quantitative information. So that brings us on then to the last part of the strategy component. So firstly, we looked at identifying the risks and opportunities, then the effects of those risks and opportunities, and now this final group of disclosures is looking particularly at how the company can prepare for uncertainties and ensure its resilience into the future. And so this really gets into the practices and processes that a company has in place to assess its own resilience and make strategic adjustments where it needs to. And disclosures here should include information on what types of assessment might have been used, and in particular, if and how climate scenario analysis has been considered. And at the heart of it, resilience disclosures are asking companies to assess their long-term resilience to climate change and think about the different inputs and key assumptions that have been used in that assessment. So we're going to dive deeper into scenario analysis shortly, but some of the opening questions that companies will want to consider asking when they're starting to think about how to disclose this topic will be to think about basically what is the company's overall capacity to react or adjust to those risks and uncertainties that have been identified, and what different areas of uncertainty might need to be assessed to better test how resilient the company is to these issues. So again, a couple of examples that hopefully might help to show what this might look like in practice. So this first example here comes from Stora Enso, which is a Scandinavian forest products company. And what they really show us in these diagrams is, again, the transition they're hoping to make in their business to really respond to the risks and opportunities they've identified and embed them into their strategy and decision making. So in the top visual, we see in the bottom part, forests, pulp, and traditional wood products make up their sort of core business as usual activities. But what they've really identified is that in the future, they need to continue to focus on growing different areas of business. So this is partially because they're expecting to see a decline in revenues from their traditional business, but also because they've really identified growth opportunities in these other areas. So that's around sustainable building solutions, around renewable packaging, and around biomaterials innovation. And then in the second half of the excerpt at the bottom of the screen, they summarize how they expect the makeup of their sales revenue to change over time. So where paper and forest products traditionally in 2006 would have made up a lot of their revenue, by 2030, they're actually expecting things to sort of inverse and for these new growth areas to be where most of their business sales come from. And in the reporting kind of narrative alongside these diagrams, they do provide a sort of quantitative estimates for some of these revenue figures as well. And so they really give us a sense of the long-term view that they're taking to position themselves as a business that's moving from sort of traditional pulp and paper to a renewables material company. So giving a sense of the actions as well that they want to take to address that and that they're already taking. So for example, how they're planning to acquire new businesses, convert their machinery to be ready for these new materials and other steps in terms of innovation. And a second example here as well, because there's lots of different approaches that can be taken to disclosing this information. So a slightly different approach from the company Solvay, which is a Belgian chemicals company. And in particular, we're highlighting in this example the approach they've taken to reporting on the financial effects of risks and opportunities and on the assumptions that they've used in their scenario analysis. So in the top part of the disclosure, it's a brief summary of the methods that they've used for their climate scenario analysis. So here they've explained which scenarios they've selected, which areas of the business they've included in the assessment, and which individuals and organizations have contributed to conducting that assessment. So it's great to use a tool like scenario analysis, but it's also really important that your investors know how you've used it and can understand that methodology. So it's useful that they've disclosed that in their reporting. And in the second half of the disclosure at the bottom there, we're seeing a disclosure of the financial effects of the different risks and opportunities that they've reported on. So in this table, they identify the different areas of potential financial impact. So, for example, the need to phase out coal, the need to apply a carbon price, maybe if there's policy changes, for example. And then in the table, what they've done is under two different climate scenarios, they've identified what kind of financial impact they expect to see from that risk opportunity. So whether it's a decline in revenues or an increase. And they use a qualitative scale from -3 to +3 to show the potential direction and magnitude of that financial effect. Okay, so just to wrap up this question, I've got a quick poll question for you just to test whether you heard one of the points I covered a little bit earlier in the segment, which was around that point around disclosing qualitative or quantitative information. So I mentioned that there were a number of cases when it would be acceptable for companies to disclose qualitative information either instead of or in a mix with quantitative information. So take a moment to have a think and let me know which of those you think would be reasons that are acceptable to disclose that quantitative information. So either if the company can't separate the effects of a climate risk opportunity from other effects, if there's a high level of measurement uncertainty, or perhaps if the quantitative information sheds a negative light on the company. So I'll give everyone a moment to have a little think about that before we show you the results. Okay, just give it a few more seconds. I see the numbers still going up, so thanks everyone for taking part. And then I think I'll share the results with you now. So indeed, most of you who answered this question were correct. So those top two options, A and B, are both acceptable reasons for disclosing qualitative information. But as most of you gathered, the bottom option is not a correct answer. So it is, of course, important that if you do have quantitative information about risks or opportunities that could have a negative impact on the company's financial performance, that it's important that you are transparent and report that information to your investors. That's a general principle in accounting, of course. And you saw that in those disclosure examples that we looked at there from Solvay and from Stora Enso as well, that both of them were transparent, that they expected to see, some areas of their business decline whilst others grow. So important to provide that balance as well. Great, thanks everyone for that. So I'll be passing back to Lois now, who'll get us started on the next aspect.
Thank you, Fiona. Well, we've looked at the governance requirements and some of the strategy requirements. Now, in governance, the climate-specific requirements are not that much different. So the questions about governance are asking broadly the same information. But with strategy, the strategy pillar, there are some climate-specific considerations we need to take into account. So let's have a look at those. And we're going to have a little break at the end of this section, by the way. So this slide is entitled From TCFD to ISSB, but don't worry if you don't know the TCFD recommendations, because the list that we're going to go through tells us what we need to know about the strategy-specific climate considerations in the standard IFRS S2. So first of all, S2 requires a company to refer to and consider the applicability of industry-based disclosure topics, which are set out in the industry-based guidance for identifying climate-related risks and opportunities. And you can find that industry-based guidance on the ISSB website. Now, an example would be If you're in the personal products industry, for example, the industry-based guidance might ask you to consider topics such as where you source palm oil from and whether that is an accredited source. Secondly, S2 requires detailed information about where in the business model and value chain risks and opportunities are concentrated. So, for example, if there are physical assets that are particularly vulnerable to physical climate risk. Thirdly, S2 asks for detailed information about the effects of climate-related risks and opportunities, and in particular, how a company has responded to or plans to respond to the risks and opportunities it has identified. And a response might include the development of a climate transition plan or the development of climate-related targets. We'll talk more about that in a moment. In providing disclosures about the current and anticipated effects of the risks and opportunities on a company's financial position, financial performance and cash flow, S2 sets out criteria for when quantitative and qualitative information is required for disclosure. So, recognizing that it can be difficult to provide quantitative information, the standard says that qualitative information only is permitted in some circumstances. For example, if a company cannot separately identify the climate effects of a risk or opportunity, can't distinguish them from other causes of that risk, or when the level of measurement uncertainty to get the quantitative data would be so high as to make the result not useful. Then when preparing disclosures on anticipated financial effects, S2 requires a company to use all reasonable and supportable information available to it at the reporting date without undue cost and effort, using an approach that is commensurate with its circumstances. And what this means is that the company just has to be reasonable in its approach, do what it can really with the expertise and resources it has available to it. We've heard, haven't we, that in S2, it is a requirement that companies should use climate-related scenario analysis for assessing their resilience to climate-related risk. But just note that S2 does not specify the particular scenario that the company should use for this purpose. It's up to the company to decide which scenario to use. Finally, S2 requires information about the resilience assessment, including any significant areas of uncertainty the company has considered in its assessment, whether and to what extent the company has the capacity to adjust and adapt its strategy and business model over time in order to remain or enhance its resilience, and thirdly, what details relate to the climate-related scenario analysis. So, for example, which scenario was used, when the scenario analysis was carried out, and so on. Now, I just mentioned that one of the responses to the company's assessment of climate-related risk and opportunity strategically can be to set or develop a climate-related transition plan. So what is a climate-related transition plan? Well, S2 defines it as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. So, because a transition plan is an aspect of the company's overall strategy, it should align with the company's overall strategy, its business case and business motivation for that strategy, identifying which decarbonisation levers are most economically, technologically and strategically feasible for the company to use in advancing its transition plan. Secondly, the transition plan could or should align with science so that it should look at what science says about requirements for net zero to be achieved, or carbon neutrality or Paris-aligned goals, and how they are explained in terms of the science and how the transition plan can align with that. Thirdly, the plan should include long-term transition goals, and these should be supported by activities and targets to achieve those goals and interim targets to monitor progress towards the long-term goals. The plan should be transparent about what dependencies, risks, and challenges of executing the plan might apply. Of course, there's uncertainty surrounding the transition. So really in this bullet point, we're asking about on what does the success of the transition plan depend, and how might that success be challenged by different uncertainties. The plan should therefore also explain how residual and unabated greenhouse gas emissions will be handled. As you will know, the transition plan will proceed in different ways for different sectors. And therefore, when developing a transition plan, it might be helpful to look at sector-specific pathways that different organisations have developed, because they could inform the development of the company's transition plan, and we'll look at some resources that apply to that in a moment. And finally, companies should consider how the transition plan will be evaluated by investors and other interested parties who will be looking at the plan to see if it has the hallmarks of credibility. Now, one thing to add here is that S2 does not say that companies must have a transition plan. It says that if a company has a transition plan, it must disclose details about it. And this short list here gives you some points that you might want to consider if you develop a transition plan. And bear in mind that in some jurisdictions, transition plans are being made mandatory. So you need to look at the regulatory context as well. So let's have a look at some transition plan resources. Now, importantly, the IFRS Foundation itself, as we see in the little publication with the forest on the front of it, has published new guidance. That was published in June 2020, June this year. And it's entitled Disclosing Information about an Entity's Climate-Related Transition, including information about transition plans in accordance with IFRS S2. So this is a great document, very comprehensive. It's got examples and can really help you if you're thinking of developing a transition plan. Secondly, about the same time, the UN Sustainable Stock Exchange Initiative, that's us, developed its model guidance on climate transition plans. And that again has a lot of links to useful resources, lots of practical information about how to develop a transition plan. And at the end of that, you will see a list of the hallmarks of a credible transition plan that we just mentioned. We said, didn't we, that the transition develops in different ways for different sectors, and amongst others, the GFANZ, the Glasgow Financial Alliance for Net Zero, have set out expectations for financial institutions, but also they've set out sector-specific pathways for real economy companies. We still have all the work of the Transition Plan Task Force, the disclosure elements of which have been incorporated into the IFRS Foundation now, but lots of useful resources there. The triangle on the left tells us that all of these different resources are meant to build on each other and support and be complementary to each other. So the words you've been waiting to hear, we're having a break. So we're going to have a 5-minute break. We'll play you some relaxing music, have the opportunity for a stretch, go and get a drink, but also please do ask us your questions. We've got the Q&A box for you to use. We've got experts on hand to help you. So we'll leave you to have your break and look forward to seeing you in 5 minutes. Welcome back, everyone. Hope you had an opportunity for a drink and a stretch and to think about your questions. So we've been through the governance and strategy core content areas, and now we're moving on to the third core content area, which is risk management. And this is about processes used for risk management and how they fit into the company's overall risk profile. So thinking a bit deeper about this category, the sorts of questions that you might want to ask internally in order to make disclosures about risk management are: what processes and policies are being used to identify, assess, prioritize and monitor sustainability related risks and opportunities, and how, if at all, are they integrated into the company's overall risk management process? So most companies have an enterprise risk management process, and what you're really looking for is whether and to what extent it includes sustainability related risks and opportunities. So you might also want to think about what types of inputs and parameters are used for risk management and prioritization, what criteria are used to assess risks such as nature, likelihood and magnitude, what the monitoring process is to track the development of sustainability related risks and opportunities, and whether there have been changes in risk management processes. So as we saw with strategy, there are some specific climate considerations applicable to risk management in S2 that build on S1, that sort of add more climate specificity under risk management. So again, we see this title from TCFD to ISSB, but what this tells us is that the ISSB standards are based on TCFD's work, but require a bit more detailed information about the input parameters used to identify risks, whether and how climate and related scenario analysis is used to inform risk identification, and whether and how risk management processes have changed since the last reporting period. So additional disclosures might be required to gather that information about how opportunities as well, climate-related opportunities, are assessed, prioritized and monitored. Within standard S2, we actually have a definition of climate-related risks, which is based on the work of the TCFD. So there are two main types of risk: transition risk and physical risk. Transition risks arise from efforts to transition to a lower carbon economy, and they in turn are often categorized as policy and legal, technological, market and reputational risks. Now, those transition risks, we see some examples of them in the middle of the screen. They can include increased pricing of GHG emissions, giving rise to risk, enhanced reporting obligations, exposure to litigation, and the costs of transition to lower emission technologies, the response to changing customer behavior for different products and services and information, risks associated with uncertainty in market signals, or increased costs or availability or quality of raw materials. So secondly, we have physical risks, and these include risks from climate change that can be event-driven, that's acute, arising from events such as storms, floods, droughts and heat waves, which we know are increasing in severity and frequency. Or they can be chronic physical risks that arise from longer-term shifts in climatic patterns, including changes in rainfall, reduced water availability and quality, biodiversity loss, and changes in soil productivity. And for those of you that are interested in knowing more about physical climate risks, the Network for Greening the Financial System have just issued a really useful report on this, and I'm just putting a link to it in the chat there. But in all cases, transition and physical risks can carry financial implications for a company. These risks can affect cash flows. Costs can arise from direct damage to assets or indirect effects of supply chain disruption. The financial performance can be affected by changes to resource availability and pricing, extreme temperature changes, employee health and safety, for example, for employees that work in the construction industry. So there are financial effects with all these types of risks. The standard S2 also defines climate-related opportunities, which refer to the potential positive effects arising from climate change for a company. So these opportunities might come in the form of better resource efficiency, changing to more efficient energy sources or cheaper energy sources, products and services that can be developed to respond to different and changing consumer demand that can differentiate the company against competitors and use more resilient technology, for example. It can give the company access to new markets, enhance the company's resilience, and therefore differentiate it against competitors, and give the company the opportunity to be more efficient or cost efficient, even by changing the resources on which they depend. Again, these opportunities can have financial effects that affect the company's cash flow, access to capital, cost of capital, and these financial effects can take place over different time horizons, the short, medium, and long term. Let's have an example here about risk management and the disclosure of risk. This comes from the RS Group, which is a UK-based distributor of electrical and industrial equipment, but it does have global operations. This company, RS Group, they've analysed their climate risks and opportunities for a number of years, and elsewhere in the report they identify 10 principal risks, one of which is climate-related transition and physical risks to their business. So the extract we have on the screen is just about some of the physical risks that they've identified. Their most significant physical climate risks relate to the impact of extreme heat on their distribution sites and the potential for extreme weather to cause physical damage and disruption to their customer supply operations. So you see the first physical impact of extreme heat on the first line, and the second one from impact of extreme weather on the second line. Also in the extract, you can see that they describe the risk in the second column there. They identify who is the business owner of the risk. They list the metrics that they use to monitor the progress and development of the risk and how it's going to be managed. And in the final column, they tell us what actions they're taking now and in the future to manage the risk, including building upgrades and associated capital investments and business continuity problems. So you see the activities in the reporting year that are taken to manage the risk and opportunity, and how that has an effect on the future, how they're going to manage the risk in the future. So we're now going to hand back to Robert to take us through the final core content area.
Yes, indeed. Thanks, Lois. Yeah, I'll be moving now to the fourth key content area, the fourth pillar, which is metrics and targets, and we will talk about them more into detail. So let's start with metrics. So the requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. So preparers should here disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. So for example, what is the method of calculation? What are the inputs? and what are the limitations and what assumptions are involved. So these are the key questions to be asked around metrics for targets. Requirements on targets are then designed to enable investors to understand the targets a company has set to monitor progress towards achieving strategic goals. So disclosure need to include following: whether these targets are qualitative or quantitative, and whether it is set voluntarily or required by law or regulation. Secondly, I need to also disclose the metric used to set the target and to monitor the progress towards its achievement. Another element needs to be disclosed is the baseline period from which progress is measured and the period to which the targets applies. And further, whether there are any milestones and interim targets, and if there have been any revision to a target together with the explanation about revisions. Right, so these are introduction to the metrics and targets, how this works, and we have another example, and Lois will be showing this to you.
Yes, thank you, Robert. And this example is from CLP, which is one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. We have here an extract from the 2024 Sustainability Report, and you'll see that the title is Waste Management and Material Use, and they're showing us here the metrics for 2024 about waste management and material use. Now, you've probably noticed that most of the examples we've given you in this webinar are to do with climate change. So it's good to see an example here of waste management and material use, because remember that the ISSB standards ask companies to take account of all of their sustainability related risks and opportunities. Now, the other thing to note here is that the waste management and material use metrics that we see on this extract they come from a strategic viewpoint. So CLP has set a strategy and medium and long-term waste targets in terms of the percentage that they want to reduce their total waste production by. So when they show us the results at the bottom of the screen, you can see that there's telling us what the 2024 results are from their pollution reduction, for example, of waste products and how they're recycling. They also tell us whether that 2024 result is in line with the progress that they expected and that they set out in their targets. They also tell us the target by the end of 2025 and 2030, which are their medium and long-term targets. So they're promoting, as well as doing their measurement, they're living a strategy, and they are implementing the targets that they have set out and showing us the progress against those targets in this extract. So I'll hand it back to Robert now for more on climate metrics and targets.
Yes. Right. Now, yeah, we talk about the metrics and targets in general terms, and now we've been focusing on the metrics and targets for the climate topic specifically. So, as many of you know, or the TCFD framework laid out recommendations, laid out recommended disclosure, but IFRS S2 takes it further by making some of this mandatory. So under IFRS S2, companies now need to disclose industry-specific metrics that reflect their business model and operations. These are designed to help investors understand how climate risk shows up in real activities of a company. So beyond that, there are new requirements for greenhouse gas emissions. So not just overall numbers, but also detailed emissions from the consolidated group and where relevant joint ventures and associates. For financial institutions, that includes finance emissions as well. So there's also a dedicated framework for Scope 3 greenhouse gas emissions built into IFRS S2 to help guide consistent and decision useful disclosure. And one last point here, while IFRS S2 does not explicitly say you must break down emissions by gas like CO2, methane, etc., IFRS S1 includes disaggregation requirements. So if showing those gases separately gives investors material insights, then yes, they should be disclosed. And likewise, there are some additional disclosures compared to TCFD for targets as well. So, for example, IFRS S2 requires disclosures about the latest international agreement on climate change, how the latest international agreement on climate change has informed the target, and whether the target has been validated by a third party. IFRS S2 also requires disclosures of more detailed information on greenhouse emissions targets, including additional information about any planned use of carbon credits to achieve companies' net greenhouse gas emission targets. And IFRS S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. Right, so these about the climate targets. Let's now touch on greenhouse gas emissions. That this is one of the most common topic that comes up when talk about metrics and targets under IFRS S2. So just to recap, for anyone newer to this space, Scope 1 covers direct emissions, so things like your own facilities or company vehicles. Scope 2 covers indirect emissions from purchased energy, like electricity or steam. And Scope 3 is everything else across your value chain. So you might think about suppliers, distribution, and also the product use. So IFRS S2 requires companies to disclose all three scopes and the gross absolute emissions using Greenhouse Gas Protocol standard. There is some flexibility here though. So if your local regulator requires a different method, you can use that in the first year thanks to the transition relief embedded in the standard. You will also need to disclose if you use any internal carbon price to guide decision making and whether executive compensation is linked to climate performance. Not long time ago, in May 2025, the IFRS Foundation published a really helpful Q&A style educational piece on how to meet the disclosure requirements, especially around Scope 3. So we definitely recommend taking a look if you haven't seen it yet. And with this, I'll be handing over again to Lois, and she will walk you through another example.
Thank you, Robert. And this example is about how Enel, which is an Italian producer and distributor of electricity and gas, has made disclosures about their greenhouse gas emissions. Now, this is an extract from their GHG inventory 2024. So the inventory contains lots of details about their GHG emissions. This is just a small extract. So the other thing to bear in mind is that the GHG inventory is prepared in the context of the company's ambition and strategy to achieve net zero emissions by 2040 and to promote energy generation from renewable sources. So again, thinking about the link between strategy and emissions. But in terms of the emissions metrics disclosures at the top of the slide, you can see the company's carbon footprint broken down by scopes 1, 2, and 3. The dark blue graph bars show us the results of 2024, and the shaded blue graph bars show us 2022. So you can see the trend over time. You can see the decline in all scopes of emissions between 2022 and 2024. But you can also see where the main sources of GHG emissions are, Scope 3 emissions being the main source, but bear in mind that Scopes 1, 2, and 3 emissions measure very different things. So you have to be careful about how you interpret this. At the bottom of the screen, we can see an extract which gives us a further breakdown of the company's Scope 2 emissions from electricity and heat. The breakdown they give us is by activity, in this case, power generation and others, by source. So the source is from electricity consumption from the grid in power plants and from electricity consumption from the grid in terminal ports in particular locations. Again, they tell us the results for 2024 and 2022 with a percentage reduction or change in emissions, so that you can track what's happening in each of the power generation sources. And finally, they break this part of their Scope 2 emissions down by calculation method. The location method reflects average emissions intensity of the local electricity grid to which the company is connected, and the market-based method reflects emissions from electricity based on the contractual terms that the company has entered into with the provider. Now, these calculation methods apply only to Scope 2 emissions, and please bear in mind that this is only a small extract designed to show you the way in which emissions are compared over time between scopes and how information is then broken down further. So let's have a look at a Zoom poll now. And the Zoom poll, we ask you to think about what is the objective of metrics. In particular, what is the objective of the requirements in the standards about disclosing metrics? So you can select as many as apply. Is the objective to understand performance in relation to the entity's sustainability related risks and opportunities, or to understand progress against targets, or to understand the company's assumptions for the future? Give you a moment to think about that. Let's have a look at the results. Yes, most of you answered A and B, and that's absolutely right. So well done to most of you. Now, for those of you that answered C, you're right. Of course, the metrics can help you understand the company's assumptions for the future. But the reason we've asked you the question this way is to really encourage you to read the standards themselves. Because at the beginning of each core content area, the standards set out the objectives of the disclosures. And in the case of metrics, the objective of the metrics disclosures is to elicit information that helps report users to understand the company's performance in relation to sustainability-related risks and opportunities, and to understand progress towards any targets. So whilst it might also help with understanding assumptions for the future, what the standard wants is A and B. So it might just help you to craft your disclosures by looking at the objective of the requirements. So let's move on now to look at the next area of our Align module. We've covered all the core content areas, but you're aware that in addition to what the standards ask for, it might be that you're asked to provide information in response to other regulatory requirements, or to make additional disclosures for wider stakeholder needs. And that's what we're going to be talking about here. So we've already talked about, haven't we, the global baseline, and we know that's reflected in the standards, but in addition, you might need to respond to local requirements, listing requirements, give information that reflects how you respond to policy objectives aimed at promoting sustainability, like subsidies for sustainable practices. You might want to provide disclosures that align with emerging industry practice or peer practice, showing how you manage sustainability risks and opportunities in your sector, or you might want to respond to wide stakeholder needs on the company's impacts, for example, on things you've identified through your materiality assessments to ensure a comprehensive disclosure practices. So in addition, of course, that some of these requirements might come from specific jurisdictions, and national regulators are actively considering how to incorporate ISSB standards into their domestic frameworks, including decisions on timing, scope, and alignment with existing reporting requirements. So I won't go through all the statistics here, but if you're interested in this, as of June 2025, the ISSB published an update showing that 36 jurisdictions have adopted, used, or are finalising the adoption of the standards. We also have corresponding jurisdictional profiles and snapshots, so have a look at that to see what the activity is in the jurisdictions in which you operate. There are a number of different tools and mechanisms that the ISSB uses to engage with jurisdictions around the world. They list the jurisdictional sustainability consultations. There's a regulatory implementation program and a roadmap development tool available. So because companies might be already or choosing to report under different frameworks, as we saw earlier when we asked you about this, the ISSB is keen to support what they describe as interoperability, to make sure that whatever a company is using in terms of frameworks and standards and guidance, that they are as aligned as possible. And this is part of an ongoing interoperability exercise. We've already heard that CDP's aligned its climate questionnaire with IFRS S2. The greenhouse gas protocol is the protocol that must be used unless other requirements apply in your jurisdiction for calculating greenhouse gas emissions. And the ISSB works closely with the GHG protocol team, both for technical update, but also for governance arrangements. We'll talk about GRI in a moment. And we know that the Transition Plan Task Force disclosure-specific materials are now the responsibility of the IFRS Foundation. On the nature side, to support interoperability, the ISSB is considering how it can build on the recommendations of the Task Force on Nature-Related Financial Disclosure to meet investor needs. I said we'd come back to ISSB and GRI. There's quite a lot on this slide. Some of it dates back to when GRI and ISSB did an exercise, which you see in the thumbnail on the left, that concluded that their GHG emission requirements were very well aligned. But the important thing to note really about ISSB and GRI is that in June, the GRI's standard board granted equivalence to IFRS S2 climate-related disclosures for Scope 1, 2 and 3 GHG emissions under GRI 102. And what this means is that your GHG emissions information prepared for ISSB purposes will be treated as satisfying the requirements of the GRI standard 102. So there you have a real-life example of interoperability in practice. They also have a collaboration to deliver full interoperability, starting with GRI's 101 biodiversity standard, and this will feed into the ISSB's project on biodiversity ecosystems and ecosystem services. And there are various types of governance arrangements to try to keep the organisations aligned as possible. And in fact, the IFRS Foundation was a convening partner of GRI's Sustainability Innovation Lab in Singapore. Now, maybe not for this audience so much, but some might be wondering about what's the relationship between the activity in Europe to develop the Corporate Reporting Sustainability Directive and the ISSB. Well, under the European directive, there are European sustainability reporting standards that must be used to report under that directive. And those standards are designed to meet the information needs of a wide stakeholder group who may be interested in impacts as well as risks and opportunities to a company's prospects. And really, the reason for any differences between the ISSB standards and European standards is because of these different objectives, with the European standards more focused on wider stakeholder needs and ISSB on investor information needs. Having said that, they've already found that there's a high degree of alignment between their respective disclosure requirements on climate change. And there's a joint statement you can find referenced at the bottom of that slide that, that confirms that alignment. And again, how you can prepare one set of GHG emissions data that complies with both standards. So I think some of you were using integrated reporting, and this slide is just to note that the integrated reporting framework can still be used as a complementary tool to support your ISSB disclosures. Because the integrated reporting framework very much focused on investor information needs, but also helping to provide disclosures that give a holistic view of the value creation process and a complete picture of how value is created over time. So if you are interested in that, take a look at the guide you see on the left of the screen there, the transition to integrated reporting. It will give you dedicated frequently asked questions, a mapping tool, and a getting started guide to integrated reporting. But maybe the most important thing about integrated reporting is it's underpinned by integrated thinking, and this very much enhances the quality of a company's corporate governance. Just to go back to something I said earlier, although GRI and ISSB are aligned on GHG reporting, you can't assume the same for European standards, so just pay attention to that if you're affected. But integrated reporting still very relevant. So let's have a look at this Zoom poll here, and it's asking you to give one answer here, please. When considering your disclosure objectives, should you take account of the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance? Yes, very quick participation here, and I can see you already know the answer. Of course, you know the answer, the final one. Take account of ISSB standards, regulatory requirements, and other sources of guidance. And good news is that all of the developers of these sources of guidance are seeking greater interoperability, as we just discussed. So we're going to hand back to Fiona now to take us through a summary of Module 2.
Brilliant. Thank you so much, Lois. So as Lois says, that brings us to the end of Module 2. So you might be thinking, 2 of 4 modules, we've got a long way to go. As I said at the start, Module 2 is a really significant one in this training because, as you'll see, there's a lot to cover just to introduce the standards and all of the content and explain that to you fully. So it's where the bulk of our time really is in our training session together. So thanks everyone for your involvement and engagement so far in the training. But to this second module, let's just remind ourselves of a few of the key things that we've learned. So we reviewed all of those 4 core content areas of the ISSB standards: governance, strategy, risk management, and metrics and targets. But an important thing to remember about these is that whilst they're separate categories of information, they don't operate in silos. And so we saw that in the disclosure examples from many of the companies that we looked at, that they were in practice interconnecting between those different areas. And we also discussed how your disclosure might go beyond the S1 and S2 requirements, for example, to meet the needs of different stakeholders, or perhaps to meet regulatory requirements or industry standards in certain jurisdictions. And so what's important to remember when you're doing this is that the ISSB standards has been purposely developed to act as a baseline. And so the building blocks approach that we've introduced allows report preparers to add additional disclosures on top of that baseline. However, in doing so, report preparers do need to be careful that they don't obscure the basic requirements of S1 and S2 as well, and keep that focus on concise disclosure. Okay, so to wrap up this module, we're going to be doing another exercise as we did for our first module. And our second exercise is all really thinking about gaps against that alignment. So we've talked here about what all those different content areas are. And for many organizations, the next step now is going to be to think about what are your gaps that you need to address in order to fully align to the content requirements that we've discussed. And so this is where we'd recommend organizations, of course, to go away and do a more structured gap assessment. And there's a checklist that we've shared from the SSE, as well as a smaller version in the homework sheet, which you can use to help you here. But probably as you've been listening to this section of the training, you might already be thinking about some key gaps that are applicable to your organization, or maybe the organizations that you're working with if you're not directly a report preparer. And so it'd be useful just to reflect now together on what's kind of coming to mind for you already. And so some of the types of gaps perhaps that you might be thinking about would be particular content requirements. So maybe we've talked about a new topic of reporting that is something that you would need to address that you don't currently disclose. Or secondly, perhaps there might be processes that you think would need to be developed internally to support what we've talked about. So maybe on risk management, for example. So it might be that you're thinking about there are new reporting processes that you need, or maybe adaptations to existing processes or well. Or perhaps you need new skill sets and resources in your organization. So let's take a moment together in Menti again, just to reflect what's coming to mind for everyone about those key gaps. And as I've said already, if you're a report preparer, feel free to answer from your own organizational perspective. But maybe if you're in a slightly different position, you're welcome to share a gap from the perspective of what your role in this would be, or maybe otherwise what you think key gaps could be for preparers that you might be working with or reviewing the content of, for example. Okay, thanks again for responses. It's always great to have lots of content coming in to talk about. And again, obviously, there's no right or wrong answers here. I think it's useful just to reflect and think about what your priority is in terms of a gap here. And also maybe for others to see maybe what you're thinking about, because it might be that you've thought of a gap that others haven't that will be useful for them, and vice versa too. So someone, I know Stephen mentioned in the chat, lack of data, and indeed that's often something we hear very commonly across many markets. I can see that in a couple of the responses that we've got in Menti as well, where I'm seeing data quality mentioned, or maybe just availability of that data as well. So absolutely thinking about how you can kind of obtain the information that you need to support your reporting processes is likely to be key. And that could be things that you maybe can gather from your stakeholders, maybe from your suppliers or customers, for example. But it also could be data maybe that actually exists somewhere in your organization already for different purposes, but maybe you don't know about it. So as much as you can there, thinking about how you can build off what might already exist in the organization is a great starting point. So people are talking about data and the limitations of coverage of scope. So maybe that's talking about emissions reporting in particular. For many organizations, indeed, obviously, the starting point will be their own scope 1 and scope 2, but obtaining scope 3 emission from your value chain can be quite challenging, of course. So we see also some responses here around lack of ethical nudges or conscience-driven decision frameworks, especially relevant if you're embedding values. So maybe not having the organizational culture, if I understand that correctly, yet to really embrace and integrate these factors. So that's a really interesting reflection, and definitely something that if you can take steps to consider how you can influence that organizational culture to drive the right approach, as you say, to embedding these values, that will be a great way to set your organization up in the long term for success here. I see quite a few mentions around data as well, again, or maybe kind of currently not feeling as though you're compliant with requirements. So, of course, meeting regulatory compliance requirements is a key starting point, of course, if you're not currently ready for those. Someone has mentioned as well around the need to assign oversight to a board committee or subcommittee and include different KPIs in management performance. So yeah, getting your lines of responsibility and governance in place so that it's clear what oversight that they will provide for these processes is a good foundation as well. I'm seeing mentions as well of it's a good suggestion here about, of course, with the Fijian reporting requirement that Shara spoke to us about at the start as well. Of course, that's a great structure to conduct your gap analysis against as well, against those national requirements. A few mentions of kind of some of the climate specific aspects maybe being kind of gaps that you need to address. And indeed, that's also something we commonly hear as well. So for many organizations, the level of specificity on the S2 standard for climate is a new thing. So something to focus on too. Some people are mentioning here around the needs to introduce staff training and internal communications on sustainability reporting and reporting expectations. Indeed, so that's going to be a good place to start, is to help your colleagues to understand what their role on this topic will be, and that this isn't necessarily something that one team can tackle, but actually sustainability, finance, risk, etc. all need to work together on this. So indeed, I think spending some time upskilling your colleagues so that they can understand the importance of this topic and what their role in it will be is a good starting point too. A few other mentions around training and awareness, around setting targets perhaps as well. Great. So lots of different ideas coming up here. So it does show, there's a real diversity, of course, in different focus areas for organizations, but equally some common themes. So hopefully somewhat encouraging to know that you're not alone in tackling these challenges, and indeed there are lots of common challenges across organizations. So encourage you to look at external disclosure examples from other companies as well, who kind of share their reporting journey, so you can see how they've addressed some of these issues. So great. I think lots of things identified here that are really relevant from what we've discussed so far. Some things I think that we would highlight as well that are great to think about at this stage is thinking about how you can integrate this information perhaps into annual report. So for some organizations, that's a new aspect here. They might have previously published standalone sustainability disclosures or reporting, and the S1 and S2 standards are very much focused on that connection and integration with financial disclosures. So thinking about whether that brings in any new process or governance requirements and how you connect together financial and sustainability reporting is another consideration for many organizations. But overall, what we'd recommend, of course, here is to take away this initial understanding and reflection of your gaps and do a bit of a more structured assessment. And what you might want to think about there as well is also the prioritization of these gaps, because whilst it's fully understandable and recognized that disclosures are going to mature over time and that there will be gaps to start with, it might be that some things, are quite key to get in place for your first disclosures. So thinking about what you prioritize first and maybe what could be evolved and iterated over time is also something that's good to reflect on at this point. Great, thanks everyone for sharing with those points again. So that wraps us up on module 2, and it will be Lois, I believe, getting us started on module 3 now.
Yes, thank you, Fiona. We've really been focusing up to now on the detailed content required for disclosure. The purpose of the standards is to tell companies what to disclose. But there's less information, but there is some about how to do that. So what we're going to do now is to have a look at some of the how-to aspects of disclosure, the preparatory and practical aspects that prepare you for disclosure. So there are three parts to this. First of all, identifying sustainability-related risks and opportunities. I'll take us through. Then Fiona will tell us more about the evaluation aspects of disclosure, so how you might evaluate using scenario analysis, for example. And finally, we'll look at how to integrate sustainability considerations into your existing practices and processes. First of all, though, identifying sustainability-related risks and opportunities. Well, the good news is that there is guidance. But before we get to that, bear in mind that IFRS S1 asks companies to provide material information on all sustainability-related risks and opportunities that could be reasonably expected to affect the company's prospects, and S2 sets out the requirements for climate. So what about risks beyond climate? We only have the climate standard. What if you want to report on water or waste or biodiversity or social issues, for example? Well, S1 helpfully directs companies to sources of guidance to support the identification of risks and opportunities beyond climate and information to disclose about those other risks and opportunities. In particular, when identifying which risks and opportunities to disclose, S1 says that companies must consider the SASB standards. And as we've heard, these are the sector-specific standards you can find via the ISSB website that help you to identify the disclosure topics, amongst other things, that might be most relevant for consideration for your sector. In addition, companies may consider the IFRS Foundation's relatively new educational material on sustainability-related risks and opportunities and the disclosure of material information. This is very comprehensive, contains examples, and is a good place to start if you're wondering how to tackle sustainability-related risks and opportunities. In addition, companies can consider the CDSB framework application guidance, again available from the ISSB website, and this covers a range of topics from biodiversity, water, and social issues. You can look at industry practices and the materials of investor-focused standard setters. That would include the integrated reporting framework, for example. And once you've identified the risks and opportunities using these different sources, you can then decide which information to report using all of the same sources I've just listed. But in addition, you can look at GRI standards and European sustainability reporting standards, either because you want to or perhaps you have to. And we saw an example of this, didn't we, when we looked at the CLP example, where they were reporting to us their waste management metrics, and they had used SASB and GRI standards to help with identification of that risk and the metrics that they would use to disclose about them. So let's have a look at an example to see how a company identifies their risks in real life. And this is a company called Ayala, which is a Philippines-based conglomerate. They're huge. They've got lots of different activities, property development, banks, healthcare, technology, and so on. And this extract shows the process they use for identifying risks to the business. And this is a process that they've updated in previous years. It's been a kind of an iterative process. And you'll see that they start with communication and consultation. So they're doing an engagement process where they seek inputs from different stakeholders on what the current risks are to the business and how they might manage those at various stages. The next step they take is to establish the context. So again, they consider internal and external factors that affect the way in which they understand risk management, goals, objectives, and policies. And this is managed by their enterprise risk management team. Having done the communication and consultation and established the context looking at internal and external factors, they then go on to identify, analyze, and evaluate the risks that they've identified. So they do risk assessment at that point to evaluate and prioritize the risks based on their likelihood and impact on the company's viability and operations. This enables them to update their so-called risk universe, their risk dictionary, their portfolio and analysis report. Third, they decide how to treat the risk. What are they going to do about it? And finally, they put in place a process for monitoring and reviewing the risk. Let's have a look at another example now, and this is from a company called Nest, which is a Finland-based company that produces sustainable aviation fuel, renewable diesel and feedstock solutions for the chemical industry. So it's using science and technology to transform waste and other resources into renewable fuels and circular raw materials. This extract is from the climate section of the company's report, and it shows how they consider risks and opportunities in two different scenarios. So they're using scenario analysis to inform their risk identification and reporting. The first scenario is called Net Zero World 2050, and in this case, they anticipate that radical and rapid emission reductions will be put in place and that temperature will rise no more than 1.5 to 2 degrees. Now you'll see, I say 2 degrees because they split that scenario across the world and for the EU and North America. And this is because the transition will proceed at different paces and in different ways in different jurisdictions, and that's why they look at the net zero world across the world and in the EU and Europe. Now, on a global basis, they expect that this scenario will give them opportunities into new markets and sectors. They expect their supply of renewable and circular solutions in the EU and North America to be supported by regulations and voluntary ambitions. Of course, they identify risks too, which are associated with competition and acceleration of new technologies. The second scenario they view their risks through is called compromised climate targets, where they anticipate that there will be failure to take climate action quickly, and therefore global warming could increase to 2.5 to 3 degrees above pre-industrial levels. In this case, they see that the risk is that the demand for their products might be constrained in this scenario, but they also see opportunities to differentiate themselves from competitors. Final thing to note about this example is that they give us an indicative financial impact to the company in each of these scenarios, and the most positive scenario comes in the net zero world 2050, and you might expect that because their business model is focused on the development of sustainable and circular solutions. But two different ways of looking at risk and how the company has informed its risk assessment. Now, finally, we've already mentioned this, so I'll just skip through it quickly, but we know that in identifying risks and opportunities, because it's a challenging exercise, the standard says that the company can just use all reasonable and supportable information available to it at the reporting date without undue cost or effort. But what does this mean? Reasonable and supportable information is specific to the company, so we're not just making general statements about what risks could apply. We're talking about risks to the company. It takes account of the external environment. We very much saw that, didn't we, with the Ayala example, where they consulted widely and looked at external factors that affect their risk. It includes information about past events and current conditions, and of course they will be known to the company, but also takes account of forecasts. And in the Nest example, we saw that they were using scenario analysis to do that. And in some cases, what is reasonable and supportable will be specified in the ISSB standards. going to hand over now to Fiona for the evaluate portion of this module.
Thanks, Lois. Great. So that moves us in, as we say, to the next part, thinking about once we've identified those risks and opportunities, how we're going to evaluate the financial effects, which of course we know can be one of the most challenging parts here. So to help investors understand this area, companies are asked to disclose information about the implication of climate change on the organization's strategy and business model. And this is asked to be disclosed over the short, medium, and long term, and to think about the company's financial and operational capacity to adjust. And so this is where we're going to want to use climate scenarios and analyze what the effects of different risks and opportunities will be under these scenarios. So it's important to remember that climate scenarios are not predictions of the future. So we're not saying what's likely or most likely to happen, or we're forecasting, but we're simply projecting what is plausible as a possible pathway, and ideally considering different possibilities, because that helps us to build a more flexible and adaptable strategy to respond to those. And so under S2, companies are asked in particular to disclose what scenarios that they have used, how they've selected them, and what the key assumptions are that sits behind them. And within the standards, there's guidance as well to support companies in determining how to select scenarios and which methodologies to use, perhaps starting with more qualitative narrative approaches and maybe moving to more quantitative and complex modelling options over time, focusing on the most material risk areas. And again, this is another area where companies are asked to use an approach that's commensurate with its circumstances and that uses all the reasonable and supportable information that's available without undue cost or effort. So a quick example here from Nestlé, who you probably are familiar with as a food and drinks company based in Switzerland. So this is just one of the many outputs from their climate scenario analysis that they disclose. And in this particular visual, they've showed us a projection for how they expect a medium emissions scenario to impact the yields of some of their key agricultural commodities out to 2040. So whether they're expecting yields to increase or decrease in different parts of the world based on physical climate changes. And what this shows then is that they're expecting a higher volatility to their agricultural product supply as a result of perhaps increased heat waves, droughts, and water stress. And so what they're expecting from that then is possible increases in price and input costs, and maybe some impacts on the stability of their supply chain. So in the disclosure alongside this, they explain how they've conducted this analysis and then some of the steps that they're taking as a result of this to improve their resilience. So for example, investing in crop science to improve kind of yields and crop resilience, and thinking as well about how to invest in innovation and efficiency. And so, of course, when we're talking about future events, we know that anticipating and disclosing the materiality here can be very difficult. And so to help with this determination, there's a number of criteria set out within the S1 standard that can help you to make this determination. And so what organizations are ultimately asked to do is to continue to evaluate the different uncertainties that exist about these future events and provide transparency about what those uncertainties are. So this is something that companies are asked to reassess each reporting period and to provide within their disclosures. So I'll leave that list for you to review in more detail in the slide handout as well. And it's back again to you, Lois, for the next segment here.
Thank you, Fiona. Yes, we're now going on to look at how you integrate sustainability-related considerations into your existing processes and practices. Now, the good news is that within your company, you're likely to have many existing systems and processes that can help with your sustainability disclosure already. But when you're thinking about whether they are useful and appropriate for sustainability disclosure, there are a few things you can think about. First, do a gap analysis. Check for gaps in existing systems and processes. Think about suitability of the process and the criteria used for sustainability risk. And suitability means that you take account of the fact that sustainability-related risks and opportunities are more uncertain, they manifest over different time horizons, and therefore you might need to expand the list of criteria you use for prioritization beyond likelihood and impact to things like vulnerability and speed of onset. You can look at your existing internal controls frameworks to see if they can be used to help with sustainability disclosure. Importantly, think about who contributes to your disclosure, which departments have processes that can help, which people have expertise to contribute, where are they, who are they? How do different internal and external factors interconnect to inform your sustainability disclosure? We saw this in the Ayala example, didn't we? How are you going to deal with uncertainties? And there will be some, of course, in your sustainability disclosure. Do you need a process which informs the way in which judgments are made about the circumstances in which uncertainties are too great to act upon? And finally, you need to think about resources. If you do need to adapt an existing process or create a new process, are you going to need to go through a change management process or a new budget request process to get those adapted or new processes in place? Now, this takes us on to the use of a disclosure plan. Now, you know that your homework, your suggested non-mandatory homework, is to develop a disclosure plan to help with the development of your sustainability disclosure practices. A disclosure plan, we suggest it because it helps you to take control of your company's narrative. You'll note that the requirements ask you to report on your company's strategy, your company's GHG emissions, your company's resilience analysis against climate risk, and so on. So it's really, the disclosure plan helps you understand how all these things apply to your company. It can support internal collaboration, knowledge sharing, and cross-functional team discussions so that in your disclosure plan, you can make a note of who will be involved. Will it be people from risk management, company secretarial, procurement, or finance? How will you organize those individuals and departments, and what will their responsibilities be? You can create a reference point and audit trail through your disclosure plan about how certain things are done, like how data will be sourced, which systems and controls will be used, whether you will seek assurance and on what information, what will be the sign-off procedure, who will sign, and where and how judgments have been made. So a disclosure plan acts as a standalone audit trail and reference point that it explains and records how you're going to prepare your sustainability disclosures, and it can be incorporated into a wider disclosure strategy that takes account of other types of disclosure that you might have to or want to make. So let's have a look at an example now of the sorts of things that you might want to put in your disclosure plan and how they've been reported by a company called Novo Nordisk, which is a Danish pharmaceutical company. And this illustrates the basis on which the company has prepared its report. So it outlines in the second paragraph there the standards and practices the company has had to or chosen to use for its disclosures. So you can see the long list there. They've used the GHG Protocol, Science-Based Targets Initiative, the TCFD, the GRI standards, the Danish Financial Statements Acts. But what this means is the reader knows which frameworks, standards, and rules have been used to prepare the report. In this extract, the company also explains the approach and scope they've used for data collection and verification of their reports, why and how changes have been made to their reporting, including how they've corrected errors, the time horizons they've considered. You can see that in the third paragraph there. They define what short term as 1 year, medium term as 1 to 5 years, long term more than 5 years. They explain how estimates have been used and where the reader can find information about uncertainties. There's all sorts of contextual information which, you know, you would you can record in a disclosure plan and will help you to explain to readers of your report the basis on which you've prepared it. So let's have a Zoom poll now that considers the disclosure plan, and you can only answer yes or no. So is a disclosure plan required by the IFRS sustainability disclosure standards? And you can answer yes, you must disclose your plan, or no, but it's a very helpful tool. Let's let you have a bit more of a think about that. It's a bit of a tricky question, this one. But now we've got more than half of you participating. I'll share the results with you, and you can see you're evenly split, and I totally understand why. But the correct answer is no. There is nothing in the ISSB standards that says you must have a disclosure plan and you must give us details of it. We recommend it because we think it's a helpful tool. Having said that, there are parts of the ISSB standards that ask you specific things like which methodology did you use, how did you apply your judgment. So there are specific requirements within the standard that ask for parts of what you might see in a disclosure plan, but we've just recommended the disclosure plan preparation as homework because we think it's useful. Now let's just do another quick poll before we go to the Module 3 summary. I think you'll know the answer to this. Select as many as apply. A disclosure plan can help a company to take control of its narrative, support collaboration, act as a reference point and audit trail for disclosure preparation, or skip full disclosure as prescribed by the ISSB. I can see you already, you know the answer to this. So in the interest of time, I'm just going to show you that of course you're all right. Yes, it's the first three things. And I think this is one of the first webinars we've had where nobody selected the fourth answer. So well done, you're all completely right. Over to you, Fiona.
Great, thanks for that, Lois. Okay, so wrapping up then on our third of 4 modules. So in this module, we really came back to those connections. So we learned that there are many connections between a company and its external and internal environment. And this is really what we need to focus on when we're identifying and assessing those risks and opportunities. We also talked about how to evaluate the risks and opportunities and being consistent in your assumptions when you're conducting that evaluation. And this is where scenario analysis can be a really useful tool. But if you are going to use it, it's important that you keep track of those assumptions that you're making and that you provide transparency about the methods and the sources that you've used when you report the results. And finally, as we've seen, even if some of this data maybe isn't data that you're already disclosing, it might be something that you're collecting for different reasons. Or maybe if you're not yet collecting it, you have processes that you could use to help you do so. So as much as we can, try not to start from scratch when we're preparing our approach on this. Okay, so let's jump into our Menti exercise, which we'll do quite quickly in the interest of time, but always helpful just to have a quick wrap-up question. And so when we're thinking about implementing these practices here, I think it gets into the heart of some of the gaps that we identified earlier relating to data quality, data collection methods, and how to integrate and manage data better. So what we'd like to take a moment to reflect on here is, do you have existing systems and processes or data sources that you could use to help you here? And hopefully if we can share a few ideas together, we may realize that actually there is more available within our organizations than we might immediately think of that can help us to adopt and assess these different types of risk and disclose information about them. So let's have a little look at, thanks for those who've already responded to this in the background. Always helpful just to have a few answers to look at straight off while others are having a moment to think. So some people have mentioned here around using surveys maybe to collect information, or maybe that your marketing information might help, perhaps maybe to understand your customers better and what they want. talking to different departments in the company is obviously a good general point. Indeed, you may think if you're sat within, let's say, finance, or you're sat in sustainability, that you don't know where to get this information, or it's not something that you have. But often, if you speak to your colleagues, you may find indeed that they do have information that could be helpful here. And so people are mentioning as well, looking at project monitoring, financial reporting, and performance evaluation systems, indeed. So it might be that you can adapt to those existing systems to collect new data, or indeed that there might be relevant sort of proxy information in there that can allow you to assess sustainability factors. People have mentioned enterprise resource planning and supply chain management, health and safety reporting as well. Great, lots of really good ideas. Maybe customer feedback mechanisms or operational data collection systems, maybe wider stakeholder feedback or stakeholder engagement processes that you have. Brilliant. Or maybe you have internal monthly performance reporting that could inform you here. BPR, BRP, risk management as well. Good point here. So adapting your risk management processes to allow you to assess and collect information on climate and sustainability risks is a great thing to do indeed. No need to develop a new process there, because all of the concepts of the IFRS standards on sustainability risks draw very closely on existing risk practices. So there should be a lot of complementarity to your existing enterprise risk methods there. Brilliant. So lots of great ideas here. Thanks everyone for reflecting on that point. I think lots of different things that we can all take as a source of inspiration to help us think about this. So hopefully the message there is something you agree with, that although probably there's quite a lot of complexity to how we bring this together, and some work to do to gather all of those data sources, there will be a lot that you can draw on and build on that already within your organizations to help you. Okay, fantastic. So that brings us to the close of our third module, and now moving into our fourth module, I'm going to be handing over to my colleague Landon, who'll take us through Communicate.
Great. Thanks, Fiona, and good evening, everyone. Thanks again for joining us. So we're now on to the final unit of this training, which focuses on the when and where of disclosure of sustainability-related financial information. Yeah, apologies, Fiona. I don't have a slide control at the moment. So as with the last unit, we will have three main sections, and to get us started, we'll look at the location, and in this section, we're going to clarify where sustainability disclosures should be located. Before we dive into the specific requirements, let's think a bit about how sustainability disclosures are in the context of a complete reporting package that is useful to investors. Investors already have to investors already have access to a company's financial statements. ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. These all come together in a reporting package that we call a general purpose financial report. So the requirements in ISSB standards about what information to report are based on existing sustainability-related regimes focused on investor information needs and on aspects of financial accounting standards. GRI standards expand on sustainability metrics relevant to broader societal concerns. ISSB and GRI reporting standards share some content requirements, i.e., what to report, but the ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of the IFRS Foundation, which is to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approaches to defining materiality, but they're not competing. The GRI approach is set out and understood among sustainability practitioners, where the IFRS approach is familiar to accountants and relies heavily on management judgment, aligning with existing corporate risk management processes. Together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader societal expectations. A simple example we use is where double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they're important to disclose to investors. Now, you may be asking, what is material information? And as we just noted, materiality has different definitions for different reporting standards and audiences. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. Excuse me. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities, and this is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with the definition found in the IFRS sustainability or IFRS accounting standards, rather. It's information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. An entity determines what constitutes a sustainability-related risk or opportunity based on its facts and circumstances. Entities often have well-established processes for identifying, assessing, and responding to sustainability-related risks and opportunities as part of the management of their business. Investors have also asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose the information that is not material, even if the ISSB standards include it as a specific requirement. So remember to ensure material information is clearly identifiable and that you use plain language. Ensure material information is not scattered across your disclosure, and be sure to include any additional non-material disclosures if required by regulators, but ensure it is clearly identified as such. In November 2024, the IFRS has also released further education material providing guidance for companies on identifying and disclosing material information on sustainability-related risks and opportunities, which I'd encourage you to look at for further detail. And I think I just saw my colleague Fiona share that in the chat. Now we're going to move on to another Zoom poll. Thanks for launching that. So the question is, information should be disclosed in the annual report when applying ISSB standards if A, B, or C. So A, omitting that information could reasonably be expected to influence investors' decisions. B, it could reasonably be expected to affect the company's cash flows. Or C, it exemplifies the values of the leadership team. Okay, seeing some more answers coming through. I'll end the poll in a few seconds, so if you have an answer, put it in quick. Okay, I see answers slowing down, so I'm going to end the poll there. Okay, so answers were a bit mixed. A lot of folks are correct here. So both A and B are correct. Omitting information that could reasonably be expected to influence investors' decisions. So a lot of folks got that correct. And then a good amount also selected B. It could reasonably be expected to affect the entity's cash flows. And then for C, unless it's been determined that the particular values being exemplified are expected to have a financial effect on the company, this may not be information that is necessary to be disclosed in the annual report. So disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. but S1 does not say where in that reporting package the information shall be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor here is to consider that ensuring the sustainability disclosures are provided as part of the same reporting package as the company's financial statements. So sustainability disclosures must be provided at the same time as the related financial statements. They should also cover the same reporting period as the financial statements and be authorized by the same body or individual authorizing the financial statements. Research by the WBCSD on the state of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in standalone reports. However, the ISSB standards require material sustainability-related financial disclosures to be included with the general purpose financial reports. So this suggests many companies have some way to get their internal processes and disclosure plans aligned still. Next, I'll turn it over to Lois for an example with Ayala.
Thank you, Landon. Yes, this is an example from Ayala, which is the conglomerate Philippines company we saw earlier. So as Landon was saying, companies are deciding how to present information. They may have a lot of information to disclose. And in this example, Ayala has decided to use the integrated reporting value creation process and diagram as a way of explaining how they present their information in their integrated report. So on the left-hand side of the diagram, you see that they list the types of capital that are necessary for them to create value: financial, intellectual, human, social, and relationship. And at the end of the page on the right-hand column, they explain what value has been generated through the value creation method, which is in the orange circle. Now, in terms of a navigation tool, they use this to give page numbers that direct readers to where they can find more information on the outlook, the material topics, the stakeholders, the risks and opportunities, the strategy, the business activities. So whilst presented in diagrammatic form, it's also a way of helping readers to navigate to the bits of information that explain their value creation mechanism. Final thing to note here is the use of icons. So you can see in the middle, the vision pillar under strategy, you can see a transparent version of a skull that tells us about the vision pillars under the strategy and the focused execution of them. And that relates to the value generated in the final column. So they're using the integrated reporting model, they're using page numbers for referencing, they're using icons as navigation tools to help readers get through the report. Back to you, please, Landon, for digital reporting.
Great. Thanks, Lois. And yeah, exactly. On digital reporting, we see an evolution towards it. Unsurprisingly, in a more and more digital world, technology is an emerging consideration for disclosures. Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those offered by stock exchanges. The IFRS Foundation has also created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce any new requirement. Here, a digital taxonomy provides the common elements or tags needed to make your sustainability disclosures machine readable. That makes it easier to take large data sets like information from an entire industry and bring them all together to analyze it. Digital reporting has a number of benefits. For example, it makes the reported information easier to use for analysis. Data is structured the same across businesses in a machine readable format, like I mentioned. And then tagging information potentially allows for automated checks for quality and consistency. More and more data collection and management systems are compatible with digital reporting taxonomies, which is improving processing and report preparation. And then those tags I mentioned can also have labels and descriptions in multiple languages. So if you report your quantitative data in one language, someone speaking another language can also understand what it means. So we've covered our discussion on location and timing. Let's now think about ensuring efficient and effective disclosures in terms of communication. We added this to the training because a common comment we find from companies is that there's growing reporting burden. And what we hope to highlight here is that when done correctly, efficiencies can be made to reduce that reporting burden. First of all, it's important to understand what effective communication looks like and what is required. Often companies think that if they just put all the information they have into a report, then everyone will be satisfied. However, this would be against the core concepts, in particular, fair representation. For example, it could be helpful to ask the following questions. Is the information clear and concise? For clarity, it might depend on the nature of the information. For example, whether it could be clearer to present information in tables, graphs, diagrams, plus accompanying text. And on conciseness, to be concise, disclosures need to avoid boilerplate information and unnecessary duplication of information and use clear language. Some report preparers watching today might be thinking to themselves that they still don't see what all the fuss is about. Perhaps their experience focuses on standalone sustainability reports, or they haven't had much interaction with external audits. And to the accountants watching, I say, please be kind to your colleagues. Help them understand the difference in rigor that's required in data collection, oversight, sign-off, etc. for a financial statement. This means, for example, disclosures include comparative information and are to be restated as necessary. Disclosures avoid unnecessary duplication and cross-reference as required, and information has to be material to be connected and aggregated or disaggregated appropriately. So just mentioned cross-referencing, and as you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all sustainability issues, and rather than duplicating certain information, you can cross-reference to enhance efficiency of your disclosures and avoid that duplication. Cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-referenced information is assumed to become part of the reporting package. And the last note on cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. And with that, another example from Lois.
Thank you, Landon. This example is from a company called ArcelorMittal, which is a steel producing company. And it's an example of what cross-referencing can look like. There's no prescribed way of doing it. But you'll see on the left-hand column, ArcelorMittal lists the content elements and concepts from the IFRS standards. And you'll be familiar with them now from this webinar: governance, business model, risks and opportunities, strategy, etc. And in the right-hand column, they tell us where we can find information about those content elements. So this is their way of cross-referring within the report and to other reports. So a couple of things to notice. First of all, that sometimes they're cross-referring within the sustainability report that this extract is taken from. So they tell us, for example, under governance, see governance and risk management in this report. In other cases, they're referring us to multiple places. So if you look at strategy, for example, you'll see that you can find information in the executive statement, the business model section in the sustainability report, but also in the annual report in 20F. So you can understand this, can't you? There might be multiple places to which a company would wish to cross-refer the reader, and that's exactly what we see here in this simple example. Back to you, Landon.
Great. Thank you for that. And I'll note quickly that you can also find in your handout some additional slides after this for your reference regarding consistency and aggregating or disaggregating data. So please feel free to review the handout slides in your own time for some more information on that. Now, we have sought to apply a number of mechanisms to support preparers to get started with the ISSB standard. One simple thing put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from IASB. For example, many requirements in S1 and S2 are to be applied proportionally, recognizing companies will have a range of capabilities and preparedness on these issues, e.g. qualitative scenario analysis is permitted, and you'll see the phrase all reasonable and supportable information at the reporting date without undue cost or effort, or quote unquote commensurate with skills, capabilities, and resources in a number of places. We also see reliefs for the first year of application have also been introduced and includes companies being able to limit disclosures to climate in year one and then begin reporting on their other sustainability risks and opportunities in year two. Companies are also able to provide annual sustainability related financial disclosures with their next half year reporting rather than at the same time as the financial statements. And companies not needing to disclose or provide disclosures about Scope 3 GHG emissions can apply the GHG Protocol corporate standard to measure emissions if they're already using a different measurement approach, or provide comparative information in their first year of reporting using S1 or S2. Another relief allows companies to include GHG emissions information obtained from companies in the value chain with a different reporting cycle. And then lastly, we've already mentioned a number of other sources of guidance and resources, including SASB standards, the CDSB framework application guidance, amongst many others. These reliefs are all designed to enable companies to put in place reporting practices and structures to provide high-quality decision useful information. Jurisdictions will decide when to mandate adoption, but the standards are effective from the 1st of January 2024, and we know many companies are now already preparing to adopt them voluntarily. With that, we have another Zoom poll for you that I'll launch in just 1 second. Oh, thank you. So the question is, information disclosed in accordance with the ISSB standards should be, and you can select all that apply, A, decision useful, B, material, C, misleading, or D, comparable. So I'll give you a few seconds to input your answers there. Okay, give a few more seconds, but I think you all know the answer pretty clearly, so I won't waste anyone's time. So I'll end the poll there and share results. So as you clearly saw, all the answers were correct except for C. So well done. Yeah, information disclosed in accordance with ISSB standards should be decision useful, material, and comparable. So well done. It looks like everyone's paying attention. And then the next Zoom poll is information is decision useful if it is A, relevant and faithfully represented, B, comparable, C, verifiable, D, timely, or E, understandable. And you can select all that apply here. Okay, answers coming in quickly, which I think is a good sign on this one. Okay. Yeah, well done, everyone. We couldn't trick you on this question. All are correct on this. So all these are decision useful here. So these are all included. So well done. You're paying attention. Now, moving right along, the last section of our unit looks at how you can ensure that the users of financial reports have confidence in the data you're disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. An important trust builder is showing data and trends over time. This is why the ISSB standards ask for comparatives. Comparative information provides context, helps to indicate progress, and underpins strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for estimating a metric. In these situations, it's important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. Occasionally, a company's sustainability disclosures might contain material errors, and in this situation, the company is required to restate those errors in the comparatives provided. Revisions or restatements are only necessary when there's a risk that material information is being omitted, misstated, or obscured as a result of not revising or restating the comparatives. And then the information can be qualitative and quantitative. I'll note sometimes companies express concern with sharing information they deem to be sensitive or that if shared could hinder or deplete their competitive advantage in the marketplace. The ISSB standards relieve a company from disclosing information about a sustainability-related opportunity if that information is commercially sensitive. If this is a concern you think is relevant to your company, there's further details you can read in the slide handout as well. Finally, it's important to build confidence by providing clear statements of compliance. A company that complies with all requirements in the ISSB standards, even the reliefs, is still required to make an explicit statement of compliance. We also published further guidance on this in September 2024 called Voluntarily Applying ISSB Standards, a Guide for Preparers, which I can see Fiona shared in the chat. With that, as we close out, a few things to remember. Work through the list, use tools that we provided. There's lots of the tools out there. And you can find in the handout slide deck an additional slide in the section with reminders of how to report effectively, and I highly recommend reviewing that in your own time as well. With that, I'll turn it over to Fiona to give a summary of this last module.
Great, brilliant. Thank you so much for that, Landon, and for taking us through Module 4. So before we wrap up the session, we're getting quite close to the end now, and well done everyone for staying with us throughout this training. We'll just take a final moment to recap some of the key concepts here. So firstly, we discussed where to report information. And what was important here was the audience, or who you're reporting to. So making sure to be clear from the start who the primary user of the information is will help you to ensure that this information is right for their needs. Then Landon moved on to discussing efficiency. And I think the key takeaway here that we hope you'll leave with is that less is more. So the objective here isn't to overload investors with information, because actually that could be harmful because it could obscure the information that's required. So this is where using the standards as you get started will be a good guide to make sure you're providing that information that investors need, because ultimately, of course, that's the purpose of these standards. And finally, we discussed report user confidence. And especially in the current climate of greenwashing accusations, it's important to ensure that your data is not only accurate, but that you're presenting it in a way that builds confidence among report users. And so that's where the reporting or disclosure plan that we've discussed with you throughout the training today is something that can really help you, because if you develop that plan well and you implement it, you're going to have a clear and documented process for reporting that data that investors need. Great. So to wrap us up, we have a final quick Menti activity together. We'll do this one quite quickly for time, but it's just to reflect a little bit on the different techniques that you can use in your report to make information presentable in a way that is engaging for users and also navigable, because we talked obviously about the fact that there may be overlapping content elements in different parts of the report, and you want to avoid duplicating that. So what are the best ways to make your report easier for users to navigate? So let's go back to Menti for a quick final time to reflect on that question together. Just see quickly what sort of responses we've had. Thanks again for some good responses here. It's always great to have your engagement in these questions. So I'm seeing a few different ideas. Great, fantastic. So thinking about graphics and pictorial approaches, using clear headings and tables of content, having visual cues, being consistent in how you format sections. Lovely, loads of great ideas here. Having maybe a key legend across the top that helps you to track where you are in the report. Thinking about diverse stakeholder needs exactly, and how you can ensure that they can all find their content. Great, you've clearly all done lots of thinking or already have good approaches on this already, which is great to see. So using different sectional cross-links, and maybe referencing out, this person says, to different areas. So indeed, if you don't want to obscure material information, you may need have detail that's sort of supplementary, but not necessary to put in the annual report. So doing connecting references to different disclosures that are supplementary with maybe methodologies, for example, or detail on risks is a good idea. Great. So many people mentioning structure here and having a graphic approach, making it into a TikTok. I like that. I'd love to know if you think your investor audience is hanging around on TikTok, sorry, looking for material information, but you never know. So using simple language, exactly, avoiding jargon, using executive summaries and explaining your kind of logical sequence and methods. Lots of great ideas here. Creating checklists as well, and using different sort of examples and case studies. Trying not to make things boring, of course, is always good if we can do that. So fantastic. Thank you, everyone. That's lots of great ideas there. So hopefully some inspiration for us all to take away. Okay, so one final Menti question for you now before we wrap things up. And if you remember, we had those 3 key learning areas that we started the session with. So we'd just like to take a moment now to evaluate where you think you're up to against those 3 areas of explaining the ISSB to colleagues, on using the standards, and on developing a sustainability reporting strategy. So always useful for us to test how effective our training is here and see if we can continue to improve. But thanks for those who voted already. I think we were down certainly below the midpoint, somewhere in the 2s before, and I'm now seeing sort of a middle to higher level of comfort. So fantastic to see that has advanced a little through the training session. Of course, we can't tackle it in its entirety today, but we hope that we can also help you to know where you can go from here to continue to develop your learning. So with that in mind, just a few key final slides to wrap up with from my sides to cover off how you can take forward your understanding on these topics. So firstly, we've mentioned, of course, several times the homework assignment. As we said, this is not mandatory. There's no need to complete it or submit it to us in any way, but it's an optional exercise that you can use to continue to build out your organization's disclosure plan and to reflect with your colleagues on some of the aspects we've covered in today's training. So we'd encourage you to download that from the resources section of today's event page if you'd like to take that away to use internally. And a few other key resources to highlight to help you continue your learning. And as a reminder, you can get the slide handout with links and a reminder for all of these references on the event page as well. So firstly, we have the IFRS Sustainability Knowledge Hub, which is regularly updated. It's a go-to resource for lots of information about the standards and their accompanying guidance. On here, you'll also find as well a recently launched 4 free e-learning modules that the ISSB team have developed, which are self-paced interactive knowledge checks and are also CPD certified. So perhaps something to share with your colleagues for them to help take away different areas of this as well. We'll also highlight the work of the IFC who support this programme. They have a programme called Beyond the Balance Sheet, which is really aimed at supporting emerging markets, in particular on sustainability and climate disclosure and sustainable finance. So lots of great resources, both focused on reporting, but also internal governance processes, etc., that we'd encourage you to check out at the IFC's web pages linked on the slide here. And a final reminder of the SSE toolkit of resources, which we've developed working closely with the IFRS Foundation and our partners. So just for those who might have missed this at the start, this toolkit includes this training program, but also the model guidance and a number of particular tools, such as that gap analysis checklist that we've mentioned a few times, which may be particularly useful for you. So a big well done and thank you for all of you who've stuck with us throughout 3.5 hours of training. We know it's now late in the evening for many of you as well, so we really appreciate you taking that time today to be with us. And as a big thank you and appreciation for all of that hard work, you're now able to receive your completion certificate for the training. So how to get your certificate? You need to fill out the feedback survey that Landon has just shared the link to with you in the chat. Not only is it also really helpful for us to have your feedback on the training, but that's the way that we'll issue your certificate using the details you provide us with there. So you can click that link that Landon has shared now. You'll also receive the link again within 24 hours from now, and a Zoom email will come out to everyone who joined us live, resharing that link with you. So if you fill out the feedback survey at that link, give us up to a week to receive your certificate, since we send those out in batches. And then that should be with you. Make sure to double check your junk folders as well, just in case your certificate goes there. And if you haven't received your certificate in a week's time, you can reach out to us at our contact details at the end of the presentation. Sometimes I know some organizations have quite strong spam filters. So if you know that's the case for your company, it might be worth using a personal email address for the survey as well, just to make sure you get your certificate too. For those asking, that link is just in the chat there that Landon has shared in a message, and you'll get it again from Zoom in an email. Now, as we close out, just to say a big thank you to the SSE official supporters, a group of stock exchanges and wider organisations supporting sustainable capital markets. And again, a big thank you in particular to the supporters who make this programme possible. The IFRS Sustainability Capacity Building team, and particularly Robert for joining us today, the IFC, and of course, and a special thanks today to our hosts at the South Pacific Stock Exchange, to Randy, Sharaj and team for bringing us all together in this training. And lastly, of course, a big final thank you to all of you for joining us, for your fantastic questions and engagement throughout the training session. We really hope this has been useful for you, and wishing you all the best with your future reporting endeavours. We hope you'll be able to join us for another training session in the future, and wishing you a nice evening and rest of your night as well. Thanks, everyone. Take care.